Well, hello, fools. I'm Asit Sharma, analyst with the Motley Fool, and I'm joined by Will Healy, who is a Fool contributor, longtime Fool contributor, and we are going with a tech and consumer goods power hour this hour, Will, and I'm excited to do this with you.
Yes, I think this is our first time on, so I was
First time on
seeing.
together, yeah,
Yes,
for sure.
yeah, together. Thank you. So yeah, it's finally good to be with you. So I look forward to going through.
That's great. And I lost some of your audio there. I'm not sure if it's just me, but maybe Natasha, our producer, can let me know in the chat if it's just me. But anyway, well, maybe we'll just launch in with a few questions that were left in the last hour. Well, that I think are more general questions. And these have to do with investing, advice on investing. So they're great mindset questions. I wanted to jump into the first one from Polly D. And then as you all have time, put in some questions on tech and consumer goods. We're looking forward to answering them. And that one just went away from the queue, so maybe it was answered. So let's go then with this one from Tim Jungles. I've asked others here this question. How do you go about finding new quality stocks through scanners, etc.? What's your process? And for me, and I see maybe Will has dropped out, so you can come back in to get his sound working. So let me just go ahead and answer this, Tim. Yeah, for me, this is a great question because we're always in the hunt to find quality stocks. Each of us has a different approach to the market. Each of us has different strengths that we bring to investing. I'm not talking just about analysts and contributors. I'm talking about you out there who are watching today. You bring different strengths and interests to the table and different experiences. So I tend to start with the companies that I'm most interested in following, the sectors and industries that I'm most interested in. And yes, I use screeners a lot. There are so many great screeners out there that are free to use, and we have some great screening tools here at the Motley Fool. I also have some other strategies that I use. One is just talking to talented colleagues and picking their brains. So if you happen to have friends who invest, it's such a great way to turn over ideas. I also sometimes like to go to the ETF page, facts page, or holdings page of thematic ETFs that I really like and see what professional money managers are buying in order to fulfill their particular mandate for a theme. Seeing the holdings of an ETF that may be narrowly focused in a field I'm interested in. Let's say we're going to talk consumer goods today. So will a consumer goods ETF? Just taking a look at those names is always refreshing because in some ways it validates companies I already know, but it also sometimes presents new ideas that I'm not familiar with. So that's another way. And I think reading widely in trade journals is very helpful as well. So if you have sort of a bent for a particular sector, going beyond screeners or maybe just what you can get in like financial news sites and really reading a level or two deep within that industry will turn up names you're not familiar with. I'm thinking as I speak of a publication called Tom's Hardware that has nothing to do with our CEO, Tom Gardner, Tom G, but it is a really nice site which keeps track of a lot of developments in techs from the product side to greater trends. They also review products, review GPUs, for example, if you're interested in semiconductors. So I found that to be a good way to churn up ideas. And I will say, if you are a Motley Fool member, you have access to an amazing screening tool called Moneyball. And we have other databases that are available to members as well. Our latest is called Microball. And from these tools, you can screen from a number of parameters, from artificial intelligence with some of the databases to the quality of management, to financial scores, to how well these companies are using their assets to produce financial returns. So I think there are just innumerable ways to go about the hunt and the search for great stocks, but I've outlined a few. What about you, Will? What are some strategies that you use to look for companies, maybe incorporating or even going beyond traditional tools like screeners?
Yeah, well, I do use the screeners, and I want to say they do offer tremendous advantages that weren't available in previous decades. Last May I went to the Berkshire Hathaway shareholders meeting, and of course I got to hear Warren Buffett speak, and he talked about back in the day how he had to go through the Moody's books one by one to try to find great bargains. Well, I mean, nowadays you can just go into a screener and screen out by whatever factor you can think of. And like I said, like Austin said, we have great screeners here at the Motley Fool. I also use one called FinViz, which is free. It's not as robust as some of them, but because it's free, I use it. And you're already subscribing with a Fool. You don't really have to spend a lot of money doing this either. You just have to take a little bit of effort because it's all in a screening database now. You don't have to go through all the books like Warren Buffett did back in the day. But yes, I use screeners. I'll also, like Austin said, I would talk to Fool colleagues, and I'll also just do some reading on my own. I guess maybe have an advantage because I can see what tickers people are talking about, in the media, which is not necessarily available to the general public for free. But I guess I do have the slight advantage there as well. But yeah, I think it's important to just do the research on a screener, do a lot of reading too, because reading and playing with our tools like Moneyball and Microball. I mean, those are some ideas you can find in stocks sometimes before people are talking about it too. So that can offer you an advantage. I remember that I was looking at I found Innodata through the screener last a few months ago, and I didn't pull the trigger when it was in the $5 per share range. I think and that one has taken off. I would have made I would have made more than 10x my money had I acted on that information. So it's always good to yeah just for finding new names. I think the screener is the best way. And then if you have a name that's starting to gain traction, I think sites like ours, rely on the Fool, look at our databases. I think those will help you either find stocks before they really take off or as they're taking off.
That's another great point I forgot to mention. You can read the articles on Fool.com of some amazing writers like Will. I myself have been a writer in the past, so that's a great resource of surfacing some very strong companies in the market. Okay, Will, so we've got our first consumer goods question. It's from Let It Ride. Please rank the following: ELF, Elf Beauty, Lululemon, Deckers Outdoor, Ulta, and On Holdings. I'm going to give the symbols for each of these just slowly. So if any of you want to take a look at these, we've had some requests to make sure that we make the tickers apparent. Will, so here's the first one: ELF, that's Elf Beauty. LULU, that's Lululemon. DECK, as in a deck, that's Deckers Outdoor. Ulta, ULTA, that's Ulta Beauty. And ONON, this is On Holdings. Okay, so these are all great companies, Will. I am familiar with all of these. I'm going to ask you before I try to rank these. Are you familiar with each of these companies?
I'm really not, so I'm going to defer to you on this one.
Okay, and feel free to jump in with any that you happen to follow. So all of these are pretty strong companies because they have outstanding brands in their space. Ulta is more of I would say, a straight up retail proposition, but it is a good brand for those who are looking for great products, cosmetics products in very easy to navigate stores. So let's talk about Elf Beauty. This is a company which specializes in beauty products that are less harmful, made of less harmful ingredients, has a lot of, I would say, buzz still among Gen Z and older generations, but really it's targeted towards people who want relatively inexpensive cosmetics that are a little bit more sustainable and have less of that chemical or guilt ridden association of older style beauty products. So Elf has had a very interesting trajectory. That the company has done extremely well through distribution in big channels like Walmart, like Target, for its example. Stock has had a sort of a similar volatile trajectory. We like this in Stock Advisor. ELF has been a nice performer, but recently stock has suffered there are many reasons behind that. There's a macro reason for this. Consumers are starting to pull back from some consumer goods purchases. There's also a little bit of tariff uh, fear around ELF. There was a short report, but for the long term, I think the stock advisor team really still likes the chances for ELF to be a strong returner over the next few years, and we discuss it quite often. Let me keep moving. So Lululemon, this is a brand that you would think will is a household name. I'm going to spot quiz you here. You know this brand, right?
I know the brand. I
Okay.
don't wear it, but
Did you
yeah.
know? I will be honest. I have thrown on a pair of my wife's Lululemons on occasion in the house. I don't go out on the greenway and jog in them. They're very comfortable. Having said that, okay, got that disclosure out of the way. Did you know that Lululemon's unaided brand awareness globally is 31%? That means only 31% of global consumers know this brand unless they are aided with some prompt or other advertising. So this is a brand that has still a lot of global expansion ahead of it. Lululemon again is another name. Let's put it this way: almost every name on this list has been hit in some ways by the vagaries of consumer goods spend. But it is a company that rides on two things: its brand presence and its dominance as a maker of athletic wear. And I think those are its two strengths. As long as a company focuses on that, is a little more careful about its China expansion, which we have seen it's starting to be more circumspect in that area, I think it's got a bright future ahead of it. All right, I've taken a long time, Will, so I'm going to just breeze through these last three. Deckers Outdoors, a recent stock recommendation at the Motley Fool. It is a company with some really amazing brands. When we think about Nike and Nike losing its mojo over the last few years, as the former chief executive John Donahoe turned the company from a brand driven and product driven business to a more data, data analytical business to gain market share, as we saw sort of consumers lose interest in Nike because Nike lost interest in its wholesale partners, companies like Deckers with brands like Hoka really stepped in. And this company, I think, still has growth ahead of it. It is one that's had a nice run up in the market, but still seems very reasonably valued for those who are patient and hold good consumer goods companies for a period of 5 years or more, which is one of the things at the Motley Fool we love to tell our members: hold at least 25 stocks, hold them for at least 5 years, add more if you can. Okay, and then just quickly, Ulta Beauty, again, I've mentioned this, really exposed a bit to the fierce competitiveness in the consumer goods market and some macro issues, just the economy in general. And On Holdings, another company, sort of like Deckers Outdoors, which has taken market share from Nike in the shoe wear department. One of the things about On, which is really interesting, is that they are very technically proficient. They've spent a lot of money and resources to innovate in this space. And I think they present the most legitimate challenge to Nike in terms of technical credentials. For Nike to get back on its game, it has to start going beyond the innovations, the knit material innovations that pushed it into the lead position. This is now 3 or 4 years ago. To really catch up, they have to match On. Okay, so now I will rank them. I like all these. Can I have some ties here? Let's tie up Lululemon and Deckers Outdoor. I'm going to put them in first place. I'm going to tie ELF and On Holdings in second place, and then Ulta Beauty. Okay, everyone. I promise to be more succinct in my the rest of my answers this hour, but that was such an interesting question. I rarely see those five very interesting names grouped together. It would make a nice little basket, theoretical basket for someone who's interested in consumer goods to maybe invest in or just paper follow for about, I would say, 3 years, because there's some in that group, some attractive valuations. All right, back to you, my friend.
Yeah, it just tells you how diverse consumer goods is, because these are five I've heard of, but I don't really the apparel and the outdoors I don't tend to follow as closely. But some of the consumer stocks I've been in, well, this is actually a great week for my consumer goods investments. I happen to own both Mercado Libre and Celsius, which were up huge after they announced earnings this week. For those of you who don't know, Mercado Libre, it's partially a consumer stock. It's really more of a conglomerate because they started off as in e-commerce. They quickly branched out into fintech. Fin- yeah, for those of you who don't understand fintech, especially in Latin America, where Mercado Libre operates, Latin America is primarily a cash-based society. So back when Mercado Libre started, they didn't necessarily have, a lot of consumers couldn't access the site really. Well, they could access the site, but they couldn't really buy on it because they were operating in all cash and didn't have electronic money of any kind. But Mercado Libre solved that through some of their financial products. And, it's slowly changing. I think they're becoming less cash based now, but Mercado Libre has really been able to capitalize on that. They also have a logistics side called Mercado Envios, and all of these businesses really work together to really drive rapid growth within Latin America, and that proved to be the case. Excuse me. Proved to be the case after they announced earnings on Thursday, and let me see how much they were ultimately up. Bear with me just a second. So they grew up. They ended up 7%. But they were much higher at one point during the day. Another stock that was a big following earnings on Thursday is Celsius Holdings. Celsius, for those of you who don't know, they are an energy drink company. They are the third largest behind Red Bull and Monster. They've taken a more, they've carved out a niche by taking a more nature-based approach. And they're going to, they went up a lot because they had been down about more than 75% at one point just from their highs last July because they had some distribution issues with one of their large distributors, which was more than likely PepsiCo. But they did announce that they were going to buy out a competitor, and that's interesting because a lot of times when you buy a company, your stock falls. But in this case, the stock ended up going up 28% on the day. So very huge for this one. So I think this one's on the comeback trail. I bought it a couple of months ago when it was down in the 20s. So it's 33, I think now. So very, very happy with how that did. But those are the consumer stocks I've been focusing on. I also have some in Shopify, which did fairly well last week. So I'm more like on the I should say I tend to be on the the intersection of consumer and tech. So that's more the stocks I focus on. That it's a lot of the retail sectors. And I did see a comment based on consumer goods I wanted to touch. Jersey Jester an hour ago said, Cracker Barrel prioritized uniformity over local favorites on menus. Quality quality has suffered. I will say that's as much a comment, I guess, as a question. But I hadn't been to a Cracker Barrel in some time. I usually go on road trips. It's usually a nice experience at a relatively low price. But I don't tend to go at any other times. I look at the financials because I've been seeing a lot of questions on it lately. It is a fairly cheap stock at 17 times forward earnings, but there's almost no growth in it. So if you want to keep going to Cracker Barrel to eat, that's fine. I'm not sure I would invest in that one personally. So, but yeah, there's a lot out there in consumer goods. So it's certainly a varied industry.
Well, I like that you mentioned 3 out of 4 tickers that are very widely followed and of great interest to lots of investors. So Mercado Libre, MELI was a symbol, and Celsius Holdings, and also I'm just trying to grab. Let's see. Yeah, it's CLEH is Celsius Holdings.
CELH actually.
CELH, and then Shopify SHOP. And I'm gonna make an unannounced plug here. Why do I have my selling hat on? Because it's Saturday. For those of you who are watching us on YouTube, Will just mentioned 3 recommendations that are in the Stock Advisor scorecard. So I think it's an interesting cross section of companies, Will. And this is one of the things we try to achieve in our flagship service, which is to have both a sampling of some smaller, more aggressive companies like Celsius that could be volatile, but I might have some long term potential for patient shareholders. Nestled in with those, we've got very solid companies. Now, it seems sort of amazing to call Mercado Libre sort of a mature player because it is a growth story, but it's so established, as you so nicely said, in the Latin American market. Years ago, it was just sort of an upstart company, a challenger to businesses like Amazon.com, which at one time was pointing its wide targets towards Latin America, and they really haven't invested in the way I thought because of the success of Mercado Libre, and then Shopify, which is such a great growth story and has become a very integral part of global e-commerce. All three exist on our scorecard, and we welcome you to take a look around at our products. But Stock Advisor is a great entry point for many people who start with the Motley Fool. Let's keep moving. That sales pitch out of the way. No one asked me to do that. Will, I work on this product. I'm one of the advisors on Stock Advisor. Really enjoy uh, the work we do. We have a great team that selects the stocks, and you get 2 recommendations a month. One from the hidden gem side. This is our CEO Tom Gardner choosing the stock, and then one from the rule breaker side, which is a small team where Andy Cross, our chief investment officer, myself, and also lead analyst Emily Flippen make the choice. So 2 great picks every month. I've got my sales pitch out of the way for the weekend. I've completed my quota. Let's keep moving. We've got a fun question here from Zach's a Fool. Hey, Asit, can you talk about Kyndryl, symbol KD? This is spelled KYNDRYL. KD is a symbol, Kyndryl. I find myself looking at it almost like the Pepsi to Accenture's Coke, noting that, of course, KD is smaller than Accenture, symbol ACN. Yeah, this is such a fun comparison, Zach. For those of you who don't know, Kyndryl is a smallish consulting company that is a spinoff from IBM. It is concentrated a bit in the IT services market. So this is a company that helps enterprise businesses and many names in the global Fortune 1000 with their IT departments, but it's also a very good project-driven company that helps businesses automate their functions. And it has deep expertise in machine learning. It has deep expertise in some of the, I think, less glamorous side of AI that's translating very well into generative AI. So it's a company that can help businesses speed up processes, optimize their business, do more with less. And it's signed some great partnerships with many leading AI names. So large companies like Microsoft, NVIDIA, ServiceNow. This is a company that is known within the business community, not necessarily a household name with stock investors just yet. And you can go to the Stock Advisor site if you're a member and read up on our analysis of Kyndryl. But let's set it against Accenture, which is sort of a behemoth in the industry. Accenture is probably well known by many people. It's the largest of global consulting companies, and it's really pretty good across so many verticals. Accenture tends to hire very talented professionals. It has roughly the same, I think maybe a little bit better turnover rates versus other consultants in this industry. Will, this is an industry that has a lot of turnover, as you can imagine. And Accenture, I think it's notable for its ability to keep growing earnings despite being quite a large company. Accenture is very interested in being the advisor to many businesses on AI. They have quite a capable AI team, and they've invested hundreds of millions of dollars in order to garner what should be billions and billions worth of business for them in the generative AI space. So I think both are fun companies. Both are recommended within the Motley Fool universe, and they are sort of like Pepsi and Coke in this way. If you sort of um, just look at where Accenture can help businesses with IT and automation, and look at Kyndryl, in some ways they're very similar. And I think Zach notes rightfully so. Okay, perhaps the comparison doesn't hold up 100% just because Accenture is so big, but they are similar in that regard. And I would say reputationally, uh, the comparison makes sense to me because, okay, forget armchair quarterbacks like myself on a Saturday afternoon. Within the industry, both have very top notch reputations. Kyndryl, while I call it small, is quite a bit bigger than specialist consulting companies. So think EPAM Systems, Globant, Endava, etc. It's a little bit more on the scale of Accenture. And I can think of maybe one or two other companies that I might put in that same category. So could we add, like, Keurig Dr. Pepper to the mix? Maybe Infosys as a well-known and bigger consulting company. But I like this comparison. I think it's apt. And Sadaf has a question for us about Nike. And Will, do you follow Nike at all?
Not that closely. Like I say, I'm not really so so adept on the apparel side. Apparel's kind of I feel like with apparel you really have to understand trends pretty well to understand how a stock's going to perform over time. And I'm not so good with that, so I've kind of avoided stocks like Nike. But I think from what I know, they kind of they've been suffering since they abandoned their in stores. Well, not abandoned in store sales, but tried to go more online. I don't think that took off too well with consumers, and because it's a very fickle business, mistakes like that can hurt you. So
Sure. Well, let me just take 30 seconds. I apologize. I'll answer this question really quickly then from Sadaf, and then flip it back to you for the next question. So Sadaf says, Nike didn't make an acquisition for a long time. What do you think about its partnership with Skims? Are you hopeful about the turnaround story of Nike or not yet? So, Sadaf, as you probably know, the new CEO of Nike, Elliot Hill, is a veteran of Nike, and he is a product person. He is someone who really understands the former culture at Nike, which is product driven, not category driven. John Donahoe turned it into men's apparel and clothing and footwear and women's, which is interesting for a company that used to pride itself on being able to specialize among products. So men's uh, basketball shoes, men's tennis shoes, etc. So this is interesting because it's a move that is sort of antithetical to Nike's typical strategy. As you point out, they don't really acquire a lot, but it does bring some quick mojo back. Skims is doing very well in the marketplace. I believe this is the reason that Kim Kardashian is a billionaire. It brings a little bit of excitement back to the brand, and it signals to the marketplace that product is important. Skims is known for having pretty good technical quality. I wouldn't put it in the realm of a Viore or a Lululemon technical excellence yet, but it's a very well made product. The Skims products are very well made. So Nike is signaling it wants to do more of that. This partnership is a way to sort of reinvigorate some buzz with not a lot of capital investment for such a big company, but it's a way in the meantime while Nike takes that several quarters or so to reorient how it's designing, creating, and marketing its brands to show the marketplace where it wants to go. So I like that acquisition. Back to you, Will.
yeah, I'm gonna take this question. It's slightly outside the topic, but I think it's important for investors. About an hour ago, David M asked, Berkshire sold their stake in S&P 500 ETFs. What do you make of that? Would you say would still be a core ETF for investors to be adding to the portfolio now? That is a good question because when someone like Warren Buffett makes a move, you don't really know what to make of it because rarely does Warren or anyone else at Berkshire explain why they did what they did. Yeah, and there could be a lot of a lot of reasons for the sale. If you follow Berkshire, their cash hoard went up to 334 billion, up from 325 billion in the previous quarter, and they've been accumulating cash for a few quarters right now. The fact that they sold the S&P 500 ETF could mean that they're bearish on the S&P. It could also mean that they just want to focus more on individual stocks, which has been their specialty. So we don't really know, but it is definitely something interesting to watch. Another question I wanted to address from Sadaf. Sadaf asked, can you talk a little bit about inflation and economic resistant tech and consumer goods stock? Well, so it's funny you asked that because I was just talking about Mercado Libre. One of the big reasons I like Mercado Libre is because they're able to take external challenges and turn them to their advantage. So I was talking about how they started off in e-commerce, and because it was cash based, nobody, or at least fewer people, could buy on the site. Well, they got around that by creating Mercado Pago, which allows these cash based customers to buy on e-commerce sites, and they later expand that to customers who are not using the Mercado Libre e-commerce site. So that turned out to be a great little business for them. Also in Argentina, they've been having an inflation crisis. Well, Mercado Pago offered a product where they could invest to help counter some of that inflation. So, and then they also created Mercado Envios because logistics can be hit or miss depending on which part of Latin America you're talking about. Well, Mercado Envio solves this by allowing their customers to, well, it will handle fulfillment and shipping for these customers. So Mercado Libre thrives because they take a problem and they solve it and create new business from that. So that's probably my favorite stock from that. But a lot of times, yes, most companies are negatively affected when inflation rises or the economy goes down. So when you find one that can beat those trends, that's almost always a bullish sign.
All right. So moving on, let's see. Matt asks, Asit, have you ever looked at the stock of Coca-Cola's bottler, Coca-Cola Consolidated? Does Coke hit you as a business with uber customer concentration risk? And yeah, Matt, I have looked at Coca-Cola Consolidated. I believe I wrote about this several years ago when Coca-Cola went through its exercise of basically selling off certain bottling businesses. Traditionally, Coke has worked with bottling groups and has owned some of them and has had partnerships with others, particularly overseas. It tends to partner up, but it owns some very nice businesses here in the US, either owned outright or had controlling businesses. And over the years, the company sort of spun these out or sold them. And Coca-Cola Consolidated, if I remember, some years ago, Coke spun out the last interest of that. I think it was in their last big push towards separating their concentrates business and their beverages business from the bottling operations. And yeah, to my chagrin, I didn't look carefully enough at the company. It's really done quite well with what appears to be relatively low volatility. Now, part of this, I think, comes with some risks, as you mentioned. Uh, the way the end game works with Coca-Cola Enterprises is that it's not really selling directly to Coke anymore. It actually licenses different concentrates and trade formulas, then does the bottling and distributes it to end purchasers. Those happen to be, when we think about concentrations, two really big entities, Kroger and Walmart. I think between the two is the uber concentration that you mentioned. So if you are okay with these types of models, then it could make sense to have sort of a position if you are someone who loves these beverage ideas, as I sort of do. I've been very, very amazed at how well the company has done. I haven't spent a lot of time since then because a couple of things. One is the voting control of the chairman. I believe he owns about 18% of shares and maybe has 70 some percent of voting control, which in some cases is not a bad thing. I mean, and there are some tech companies that I invest in, that I accept that, because for growth companies, sometimes you need that founder who can really call the shots and make things happen. And it's okay. You can cede some of that voting authority, but in a more mature business, it's one of the flags for me. So, what happens if Frank Harrison III, who is the chairman I referred to, just decides arbitrarily that he wants to up that concentration, let's say with Walmart, to give Walmart, a few more margin points and diminish the business with Kroger. There's really no one to stop Frank Harrison from doing this. He's got complete control. I do like the fact that he owns, and I should check this. It may not be 18% anymore, but I know he's still got a significant percentage that's above the single digits. So, having said that, we should be looking for models like this where a company quietly is in a position to have very stable cash flows. And then we can assess as investors how comfortable we are with the concentration risk. So thank you for that question. Back to you, Will.
Yeah, so Vihan asked about 9 minutes ago, gentlemen, gold, silver, bronze on the following consumer staples: Philip Morris Mondelez, MDLZ, Altria, which is symbol MO, Unilever, symbol UL, Procter and Gamble, PG, and Pepsi, PEP. Well, I'm not so bullish on the tobacco related names, so I'm going to just eliminate Philip Morris and Altria from the list. Of the three, I'd probably go Pepsi Gold, Unilever Silver, Procter and Gamble third. I think all these stocks can work for you depending on your investing goals. But I think of those, Procter and Gamble is probably the slowest one. Although, like I said, I think its business will remain robust. I think Unilever. I think Unilever is a direct competitor, but I think that stock offers more for the money. And I just see more growth opportunities in Pepsi than either of those two. So that's why I picked Pepsi as the gold pick.
I'll pretty much agree with your rankings there. And I actually too, I just don't follow the tobacco stocks. I have no problem if someone wants to invest in them. For me, it's not a place where I've concentrated my energy or attention. So just looking at those other names, yeah, I think Pepsi is a proven sort of gold name. Um, Mondelez, Mondelez itself, I like that business, and I'm scratching my head here to as I've been in the tech world for very deeply in the tech world for many years now, and I used to be chiefly a consumer goods person, so I don't remember that. Did I miss something? Will, did those two companies merge?
I guess I did too, because
I don't think
I
they
also
did.
thought they were separate. To be honest,
I believe they are,
yeah,
but
I follow that as closely, or maybe it's just the way he
okay,
typed it.
yeah, I think Vihan maybe just didn't put the symbol in there. So
Yeah.
for the ones that I'm going to address, so Mondelez, this is symbol MDLZ. This is a power snacking business that was really spun out of I believe Kraft many years ago, and it's a well-run business with some great brand names. I would give them, sort of silver. Pepsi, let's say Pepsi is gold. Procter and Gamble and Unilever, I would put probably also in the silver. Procter and Gamble, I would put sort of in that maybe bronze of consumer goods staples companies. The reason is that I just don't like, and I've never liked the way Procter and Gamble allocates its capital. It really is sort of beholden to dividend and share buybacks, which on the surface sounds like what you want a consumer goods company to do, but it's always used a lot of leverage to make sure that happens year in and year out. And that really hasn't been great for its ability to innovate, and for the mentality of the management team. They're very fixated on this financial model. Will actually got called out by management years ago at Procter and Gamble for writing about this very issue, and I think I had some bit of it that sounded a little bit snarky in the way I was presenting this information. They didn't like it, so I had a sort of long back and forth via email with the person who's in charge of internal communications at Procter and Gamble. Luckily, I had great people uh, as you know, at our Fool.com editorial team, who are also able to help me through that conversation. We became friends after that. It was all good. I could ask a few questions later from the management through that IR person, but um, just to say, sometimes you have to know where you stand when you look at a business model and just realize, okay, this isn't for me. There are others who will look at that and say, hey, Asset, you know what? I've owned Procter and Gamble for a long time. It's had decent returns for me. I maybe don't want them to go acquiring other businesses or pouring a bunch of money into R&D and maybe losing that ability to generate the free cash flow. So I'm perfectly fine the way they are. And we have to allow for those differences. And again, as I said at the beginning of the hour, sort of gravitate to what we like, what we're interested in, where our strengths lie, where we want to build our strengths, where we want to build our knowledge. If you are joining us on YouTube and you are a newer investor, you're learning about stocks and the fun world of investing in businesses, this is another way that you can really up your game, which is to say, okay, I understand what I know, and here's what I don't know. Here's what I would like to learn. And you can, form a plan of how to get better at that. I would say with the just prevalence of artificial intelligence tools, just going to ChatGPT or Anthropic or Gemini and starting to ask questions about businesses you're interested in, and then ask the model, like, what's important about this business? If I had never heard of this company before, can you tell me what you think is important? If I were to follow this company, if I were to invest something in this company, this is a really great way to learn, and hasn't been available to the average person until now. So I'm talking a little mindset here, and I lied. I'm going to give another pitch, but you don't have to pay for this service. This is just aimed at people who may already have a membership. Tim Byers, great senior analyst and lead advisor here at the Motley Fool, and myself. Every Monday at 10:30, we have a session on Fool24 called Mindset. That is going to be a 1-hour show every Monday at 11 a.m. starting in March, where we tackle these very questions like, how do I learn? What do I do when my whole portfolio looks like it's cratering because the market is going down in a hurry? How do I build a portfolio that's resilient? How do I handle the emotional part of investing? Tim Byers says that 85% of this game, the investing game, 85% of it is mental.
No, I know that all too well. I've learned that the hard way when I when
Yeah.
I when I sold too soon. Another consumer stock, and I don't think it's going to come up today, but Booking Holdings, formerly Priceline, I bought that at the bottom of the .com bust and sold it a few months later, and I missed out on basically 100-fold or more than 100-fold now in gains because I let my emotions get the better of me. I didn't pay
Yeah.
attention to it afterwards like I should have.
So much so. It seems so counterintuitive, right? 85% of it should be identifying the businesses, and I'm not saying it's not a lot of work, and it's fun work for those of you who are new to this or have been around for a long time. It is so much fun to embrace the adventure of stock investing. But at the end of the day, your success, let's just put it this way, it's not necessarily a ratio of how much time you put in of mental energy versus stock research and making decisions, but it's really about the emotional load versus what you research. At the end of the day, being able to have the temperament, being able to have the ability to make good decisions without your emotions. And here I'm glossing over. We don't even have time for me to go over my big mistakes due to my own mindset in the past. But I think this is what separates investors who really create a tremendous amount of wealth for themselves and potentially their families, and those who get stuck in a series of decisions that they keep reversing. You can tell with Will, he learns from his mistakes, as I've tried to do, and that's part of it as well. But anyway, 11 a.m. starting in March, right here on Fool24. Tim Byers and I will extend our show to 1 hour each week. I'm looking forward to that. Okay, back to you, Will.
Yes. So, Vihan asks, what about ETFs? And he suggests the Consumer Staples Select Spider Fund, symbol XLP, Vanguard Consumer Staples ETF, symbol VDC, and iShares U.S. Consumer Stocks ETF, IYK. I'm not I'm not very steeped in any one of these, but I do go and look at them every once in a while. But every time I look, it seems like the long term returns on them just lag the S&P 500. So I think I would prefer that you invest in either the S&P 500 or maybe even go into tech. The tech funds like the Nasdaq or there's a tech fund called the VanEck Semiconductor ETF, symbol SMH. Those when it comes to those, the tech ETFs tend to do better than the consumer ones. I've generally avoided those. And the consumer is a funny business because you can have stocks that you know just go up in the stratosphere, and then others that just do nothing. Just looking at the restaurant industry, for example, what's the difference between a Chipotle and a Cracker Barrel? Cracker Barrel, for example, Chipotle has been able to sustain gains since the IPO'd, I think 19 years ago, whereas Cracker Barrel really, hasn't really done much during its history. So, it's always fascinating to delve into why one does so well and why a lot of these others don't do so well. So, but if you have a consumer goods ETF, you're going to have a mix of the Walmarts, the Home Depots of the world that turn a very small amount of money into millions over time, and then a lot of others that maybe the Procters and Gambles that I don't think the ETFs typically include the underperforming ones, but like the Procter and Gambles, which isn't really going to beat the market, but it's still important because been such a great dividend payer for all these decades. So, but I think on the consumers, if you're going to invest in consumer stocks, I would invest in consumer stocks rather than the ETFs personally.
Right. Now, I'll just actually take the other side of that, Will, because maybe Vihan is asking. Let's just suppose that Vihan already has uh, his allocations to his liking among tech stocks, among maybe individual stock picks in other industries, and some other ETFs to balance out. So let's just assume that he already has um, broad-based indices, ETFs. So ETFs that are based on broad-based indices, I should say, like the S&P 500, in his portfolio. If there's a corner of that portfolio that Vihan is looking at to get into the consumer staples sector, what about these three ETFs? And I would just say, you've presented three that are among the better and more liquid, larger groups of ETFs that are sector based between the SPDRs, Vanguard, of course, with very low expense ratios, and iShares, which is also well respected, and their ETFs tend to be highly liquid and have very decent net assets that are under management. I would say from there it would sort of come down to, as Will said, maybe comparing them on a chart. This is what I would do. I might throw them up on a chart and look at their performance over the last 5 years in relation to each other, and then take a look at the current holdings and the weightings of those holdings. Also, to me, expense ratios are important, so I would glance at those. I'm guessing Vanguard is going to be the lowest expense ratio because it usually is. But this is how I would sort of think of those three if I was going to put some money into one of them. All right, so let's keep moving here. And this is from Ed. I don't understand the Motley Fool love of stocks that have an easy entry into the market, such as Dutch, and this is Dutch Bros, Starbucks, Nike, etc. Too late equals portfolio losses. So I'm reading two different things in this question. Ed, feel free to re-clarify this in the question stream. So easy entry into the market. I think by that you mean low barriers to entry. So the coffee business for one. Then we have the athleisure market. You're talking about Nike, and we went through competitors to Nike. I mean, Lululemon is a competitor in athleisure to Nike. On Holdings is Deckers. There's no dearth of companies that, with, in some cases, a few tens of millions of capital. I don't know about a few millions, but a few tens of millions in capital can compete with the behemoths. This is also a function of how much the internet, how much of cloud based businesses, how much of artificial intelligence has made it easier, has reduced the costs to come into a market. Let's not even go there just yet. But then I think you're also talking about the timing of some of these. And so I just want to point out here, I know, for example, Dutch Bros is in at least one portfolio that my colleague Emily Flippen runs. Once it's actually a scorecard, and I think she's done very well by timing just a great entry point into Dutch Brothers. Starbucks is on several Motley Fool scorecards, but many of them are winning positions because we highlighted this stock years and years and years ago, and there are many scorecards in which we never sold it. And this is something you'll see among Motley Fool scorecards. When we identify great businesses, we're very slow to sell. In our real money portfolios, we might trim positions when we think a company has gotten ahead of itself in terms of its valuation. Might take a little bit of money off the table, but the truly great businesses are the ones that create the most wealth for investors. So if you happen to find a Starbucks in the early days, or a Netflix, or an Arista Networks, or an Amazon.com, or an NVIDIA, the list goes on. I could name ones that many of you wouldn't even be familiar with. A TransDigm, symbol TDG. If you can find these companies early on, it's to your benefit to try to hold them. Of course, you always have to evaluate the business as you go along. Sometimes the thesis changes, and sometimes it breaks, and a sale is called for. But Ed, I believe that here we've got, maybe two separate questions, and feel free again to clarify, and I will definitely look for that and try to give you an answer on some clarification. Back to you, Will, and then I know we've got a few minutes left. I got one more that I want to make sure I get to. Go ahead.
Yeah, I just want to interject. I think he's talking about how it's not really easy to discern the competitive advantage of, say, a Dutch Brothers or a Starbucks. Because if you want coffee, if you want to go out for coffee, there you have a gazillion choices in the marketplace. So it can be very difficult to understand why a Dutch Bros has a competitive advantage over some of these smaller chains, because there's numerous private chains out there with dozens of locations, hundreds, maybe even thousands in a few cases. That they're just private and don't gain. It's really hard to discern why they might stand out over other competitors. If you don't understand that, feel free to just avoid the stock, because I think it's important to understand the competitive advantage of the stock you're buying. If you don't understand it, it's fine to just pass on it. I think there's like almost 10,000 stocks trading on major U.S. exchanges, not including the over-the-counter. So you have more than enough choice out there. So I would just stick to the ones where you can understand the competitive advantage.
So everyone, we're 54 minutes in. You just got your money's worth from that answer from Will. I love this answer. This is something that we tend to worry over across so many Fool portfolios. It's something that I love to think about. So understand the competitive advantage, because if a company doesn't have that, the other things may not matter as much. A big balance sheet or a great management team may not make much of a difference. So I really like what Will just said. If you don't understand it, then you don't have to feel obligated to buy that company. There are other companies out there. Then conversely, Will, if you identify a competitive advantage that you understand and it makes a lot of sense to you, this game isn't rocket science, right? You understand there is something very special, let's say, about Microsoft's cloud business, Azure, or NVIDIA's GPUs, for example. You can understand it. It makes sense to you. Yeah, feel free to get some skin in the game. You don't have to bet the farm on it. Take a small position, learn more about the company. All right, so we're going to wrap up here in the next 5 minutes. Back to you, and I'm going to make sure, again, I have one more question I want to get to before we leave the hour.
Yeah, so Ed asked, about an hour ago, Ed asked, what do you think of the possibility of Citizens receiving a $5,000 dividend check? Well, I think right now that's just speculation. Whether that happens or not is a political decision. So I have no way of predicting whether it will happen or not. If it does, though, and you get the $5,000, it might be good to reduce or pay off some debts. And if you don't have that issue to deal with, it's a great 5,000 could be a good amount to start off a portfolio. So keep it in mind, but I wouldn't necessarily count on it. and I would just wait and see what happens with that.
All right. So this question is from Sadaf. So us at Globant, symbol GLOB, Globant, has one of the highest full quant scores. And so the full quant score is a combination of um, analyst sentiment at the Motley Fool and actually investor sentiment as well. So we take sentiment readings from our investing team, and then we also have some quantitative measures. We bundle those up into a score, and Globant, a consulting company, rates very high on that. Has one of the highest full quant scores. The stock is down 27% after earnings. Can you talk a little bit about Globant and its prospects? So yeah, really briefly, Sadaf, Globant took a little bit of a beating yesterday, I believe it was, or the day before in the markets after a great quarter. Looking forward, as often happens, it gave some estimates for growth that were right around the high single digits. And this disappointed analysts who expected higher growth. In particular, it has a little bit of a concentration in, actually, it has a concentration traditionally in about 10 to 15 customers. It's very well integrated in some very big companies. Disney is one that is often called out. And so just looking at the pace of spend from its bigger customers, the company's projecting a little bit slower growth going ahead. So the market basically adjusted that pricing multiple. Now, looking at Globant as a business, and you ask about its future prospects, I think it's one of the specialists that may do well in a world where um, people are trying to figure out if they can get things done with AI versus hiring a specialized consultant. Globant is very project based. So they don't just come in and consult on general things. They have a mission in a vertical to go and implement a project. It's a requirement that's needed by a company. So an example that may, be just right for Globant would be, okay, we've got a little bit of a virtual reality presentation that we, ex retailer, wants to make available to people who come and visit our flagship Manhattan showroom. And this will extend over into Chicago, Tokyo, Los Angeles, what have you. This is a very specific use case, but you can translate this to many other verticals that it operates in. Some are more behind the scenes, so IT related. But this is the kind of thing where, and I said this yesterday in a it might have been Fool24. This is the kind of thing where IT managers and chief technical officers are asking downstream, hey, can we do this in house? And there's certain things that companies are going to find they can do very well in house with their own engineering talent using AI tools, especially those that are very coding based without much of a strategic or like architectural component to it. But I think you're going to find uh, at some point in the near future a little bit of reversion to the mean where companies figure out, like, yeah, we did this project in house, but it wasn't our area of expertise. AI helped us to get it done, but now we have to keep this in development. And we really didn't have the experts come in and help us to efficiently be able to serve up this application. And it's taking away resources at this point in time. So this is something that's going to be really interesting to watch play out. Some small tech consultants are better positioned than others to thrive in this world. And I think Globant is one of the ones with a lot of global intellectual capital spread out among Latin America, the US, and Eastern Europe, and some in India. I think they're really well positioned to be that player where AI augments their business and doesn't detract from it, doesn't disrupt it too much. And I'm glad you asked that question. I mean, this is a company that's well run. Many of the original management team members are still very engaged in the business, and just I think has hit a little bit of a slower patch with the market. As I said, just repricing that multiple. It's still a very promising company. All in all, we're at 101. I apologize.
Yeah, went
We need
by
to
very quickly, didn't it?
yeah, it sure did. The hour flew by. And it was so much fun, Will, to finally do an hour together. I'm glad we could do this.
Yes, and
And
you're back in an hour, as I understand too.
I am, but no sales pitches when I come back. And I believe I'll be on with Tyler in an hour, if I'm not
Yes.
mistaken.
Well, won't that be handy? I'm sure there's maybe some things that we didn't get to this past hour, especially on the tech side, that we can grab in the upcoming hour. So
Sounds great. And if
uh,
it's the two of you, then I'll head out. Is it the two of you for
Yes.
the next hour?
it is.
Have fun, guys.
Thanks, Asid. Hello, everyone. Welcome to another weekend edition here. Glad to be joining with Will for this next hour. We're going to do a little bit of earning reactions, answering questions, and it's the weekend. Be a little bit more long form, a little more loose. So,
Yeah.
Will, how are you?
I'm doing great. How are you?
I'm doing well. I do apologize for the slightly lower quality audio and video than normal. I'm in the middle of a pretty strong snowstorm, and so internet's a little slow as a result.
You're in Tbilisi, Georgia, right?
I am. I
Yeah.
am.
Okay. Here we're going to focus on earnings reactions, and I touched on this a little bit in the last hour when I was talking about Mercado Libre. Mercado, for those of you just joining us, Mercado Libre is basically kind of um, a mix of Amazon, PayPal, and others. Operates exclusively in Latin America, and they've been able to succeed by building all these businesses and making them work well together and separately. And a lot of times, Latin America is a region with a lot of problems, and Mercado Libre is prospered in part by addressing some of these regional issues. And so it was up huge when they announced earnings uh, Thursday afternoon. It came down a little bit over the day on Friday, but it was still up 7% on the day. So it had a nice run. So but looking at the earnings multiples, despite their very rapid growth, they're trading at a trailing price to sales or price to earnings ratio rather of 60, which I think that this one is still quite a bargain for that reason. A lot of people will ignore it because it's in Latin America. And other than owning, I think they own a distribution center in Texas to serve the Mexican market, but they really don't operate in the United States. So a lot of stocks get ignored for that reason. But I think this is one that is able to combine e-commerce, fintech, logistics. And like I said, these businesses operate separately, and they sometimes operate as one. And through those synergies, they've been able to drive massive growth. So that's one, particularly in the consumer tech industry, that I focused on this week. And I think despite the record high price, I think it closed at 22.60 yesterday. So that's a record high close for it. I think it's going to keep rising higher despite that. So, did you have any consumer tech
I consumer tech. No, actually,
or earnings, rather, I should say?
Yeah, earn it. I'm going to go in a very different direction here. Because the company I looked at a couple this week, but the ones I think I already covered Solar Edge Technologies earlier in the week. So I'll leave that one be, despite the huge pop. I think it popped like 30% on their earnings, which is a nice. One of those things that typically happens when you have a very beaten down stock that has a very, very high short interest, and then all of a sudden they produce not quite as bad as expected earnings. So good on them for that. But I did want to focus because a lot of companies in the offshore oil industry reported their earnings this past quarter. And the one that the largest, obviously, and one of the most notable is Transocean. They reported earnings, and it's one of the things that when you look at this business for a long time, they've just had to. They were the one company in the offshore oil and gas industry that didn't go bankrupt. Everybody else in the industry went bankrupt at least once during the 2010s because of the brutal decline in oil price, drilling activity, whatever you want to have. And this was the one that got through, which is nice, I guess, in some regard. The company, stock's still way down. But the thing is unlike all of its others that went through Chapter 11 restructurings, Transocean still has a pretty sizable debt load, and they've been trying to manage and whittle that back down while many of its competitors have been growing, and because they had recapitalized balance sheets, their debt was very, very manageable, been able to do a lot of other things. And if we just look at, Transocean is still taking like impairments on, some assets, as well as, a lot of like one time, and kind of still fixing the balance sheet, fixing the asset side as well. That is a little discouraging this far away from like the big downturn in the industry. I'd like to see what's going to happen in the next like year or so, especially as like some of the debt has to be refinanced. And they also announced that a CEO transition. This isn't like, I would say, the most alarming thing. Their current CEO, Jeremy Thigpen, he's been there for, I think, close to 10 years now. So it's not abnormal to see a CEO transition. But at a time when they're still trying to fix some of the challenges that they went through early on. I thought there would be a little bit more progress up until today.
Yeah, so I'm just moving on to some questions. I wanted to address this one in the last hour,
Sure.
but didn't quite get to it. Sadaf asks, can you pick 2 buys and 1 sell at tech in the tech and consumer goods category? Well, I mentioned Mercado Libre. That would certainly be one. Another one I haven't talked about much today is C Limited, and C Limited basically does what Mercado Libre does, except in this case it's in Southeast Asia, and it's a little different than Mercado Libre. C Limited, like Mercado Libre, has 3 major segments. They have e-commerce, they have fintech, and they have gaming, which makes them a little bit different. But like a Mercado Libre or an Amazon, it's a tech conglomerate. It was a big high flyer during the 2021 bull market. It came crashing down because they made some poor decisions on the e-commerce side, trying to go into markets where they didn't have a competitive advantage, and then their very popular mobile game got banned in India. So I think that in the 2022 bear market just hammered the stock. So I think it was down more than 90% at one point, but it's very much coming back now. They got out of those markets, or most of those markets anyway, that they probably should have never entered in the first place. Now they're investing in logistics to solidify their e-commerce in Latin America. So I think that's very positive. And I think they're going to get the game that was banned, Free Fire, approved again in India. They're getting some traction with some other games. So I think, and then their fintech business has always been strong. So I think between those 3 factors, I think C Limited is going to be one you want to look at. As for one to sell, I kind of have to go with Carvana in this case. Just a couple of years
It's been
ago,
a nice run.
Yeah, it's had a nice run, but it was on the verge of bankruptcy. It was able to refinance some of its debt that they almost couldn't pay. That saved them, because investors really piled into the stock and bid it up to, I think, almost $290 a share. Earnings didn't go well last time, and I think it's come down to, I think, into the 220s now. I need to check the price, but that one, I think, when you compare it to a competitor like CarMax, I think the stock is way overvalued. I don't think it's going to go bankrupt, because the stock went up so much that they can probably just issue more shares and pay off whatever debt they need to. So I'm not necessarily worried about them going under at this point, but just given some of these valuations, yes, it's close at 223. Forward PE of 111. I think that's a little bit rich for a stock that just sells used cars. Used cars is a very competitive business. So I think it's, other than the fact they have those car towers and you can do more of the sale online, I don't know if that's enough of a competitive advantage to really sustain a price like this personally. So that'd be probably the one that I would sell. So in summary, Mercado Libre and C Limited is buys, and then Carvana for the sell.
Yeah, I actually think on the share issuance thing, part of the debt restructuring was convertible debt. So you already have a bit of dilution already baked in there with the convertible debt that will, I mean, if they continue to be valued like this, of course it's going to convert, but that's just an additional risk on top of it. I actually really appreciate there's a lot of other like used car and car dealership publicly traded companies, Lithium Motors, for example. It's actually a surprisingly resilient and good business. It doesn't sound like it, but the combination of like used cars and like the service center at a dealership, surprisingly profitable elements of a business. You know, new car sales tends to actually only be like a break even at best sort of industry. So with like Carvana, it's kind of funny because like they took one profitable part of the used car business, like dealership aspect, but not the most profitable one, which is the service centers. So it'll be interesting to see, you know, if they can kind of incorporate those aspects as well, because it creates a little bit more of a virtuous ecosystem to boost returns. So on another earnings reaction one, because I believe that they reported earlier this week, or no, it was actually a little while ago. But Old Dominion Freight Lines, going from very tech centric to industrials and transportation. Old Dominion Freight Line has seen 2 years in a row of revenue declines, and the question that we got on this was 307 Fool asked about 2 hours ago. Tough environment for ODFL, Old Dominion Freight Lines. What would you say is more macro related, or have they lost some of their edge? I think with this particular one, there's obviously some macro things that we can get into, but it's not, I wouldn't call it them losing their edge, as the other people in the industry finally found religion and figured out how to do this business considerably better than they had done in the past. Part of the reason that I think Old Dominion succeeded so much in this industry is there was a lot of just kind of bad players. You know, unreliable shipping times, claims, lost or not on time, cargoes, things like that, and not having good pricing models that didn't lead to good profitability. And it was just it was Old Dominion's like sandbox to play in for the longest time. They could take market share. They could, sell their offering on we're a much better operator than anyone else, and they proved it. And one of the nice things is with LTL trucking is it's a virtuous cycle of assets, because with LTLs you're basically like going from a pickup, going to one distribution warehouse, going to another distribution warehouse, and then probably to your final destination. And so having like all of the additional distribution warehouses and all of those kind of, you call it like hub and spoke sort of model of transportation, versus in the other type of the LTL, I'm sorry, is less than truckload trucking. So, you rent a portion of a truck to move your goods, versus full truckload, which is obviously a full thing, a full truckload. And full truckload doesn't require like going from distribution warehouse to distribution warehouse. It's basically like the truck just travels from point to point, and so in that business there's not as many like advantages. But in LTL, if you have like that robust network of distribution warehouses and all that stuff, it makes a more virtuous cycle, right? Like you can go to more markets, you can do it quicker, your turnover times are faster, because your capacity has grown with the addition of warehouses and things like that. And so Old Dominion just kind of played in its own little sandbox as the king of LTL trucking for a long time. But several of its competitors have just gotten much better. XPO, SAIA, or SAIA, companies like this are doing considerably better. The bad ones like Yellow they're finally gone, and so it's just made a much more competitive industry in general. And so Old Dominion has had to like defend its market share a little bit more. And so from a strategic thing, it's not like they're a worse company today. It's not like they've done some silly merger and acquisition that has like crippled the way that they're doing their business, or their returns are impaired in some way. I think it's just a more competitive marketplace. They've lost 1 or 2 percentage points on their margins and on their returns. Like I said, revenues are a little bit on decline. I think that's we'll call that the the post-COVID supply chain constraint hangover, where, for 2021, 2022, moving goods was a very, very lucrative thing because, people didn't have anything. And so everyone was expediting things and trying to get stuff at places, and freight costs were incredibly high. Today, the capacity in freight has, built out a little bit more. There's a little bit of excess capacity in the system, and so pricing's a little bit more competitive. And after all that big pull forward in the supply chain times, there's little bit fewer orders. We're starting to see some declining survey results from like the manufacturing purchasers surveys and things like that are showing a slowing down in pockets of the industrial market, supply chain market, things like that is going to inevitably impact a business like Old Dominion. I don't think it's necessarily like again, not a crippling thing. This is just the natural cycles of trucking. We just haven't had a real like down cycle in trucking for quite some time. So we'll see how it goes. I mean, the stock's down 14% over the past year, which for a company like Old Dominion is quite a surprise, especially again, looking at it in a comparison to, the market's 25% gain over the past year or so. So I don't know. I'm actually I'm going to dig into it a little bit more, but that was kind of my initial reactions. And 32 times earnings is still kind of expensive for trucking, especially in a cyclical industry, but it's a much more attractive price point than what we've seen before. I wouldn't necessarily say like this is a screaming buy, but it's a more attractive time. And that's kind of the thing with cyclical industries is you do have to tend to some of the best like times to invest is when it looks pretty ugly.
That's very true. So, moving on. About 3 hours ago, Ed asked, "Is ZM, which is Zoom, price does not rise after earnings on Monday? Your opinion? Do you think it is time to sell?" Well, here's the thing with Zoom. Back during COVID, that they had the free online meeting service that happened to come in very handy when we were all locked down, and of course the stock zoomed into the stratosphere. And then as we got away from COVID and started going back to our offline activities, the stock came right back down. And since that time, a lot of worthy competitors have gotten into this business. So I'm just looking at the growth numbers right now. So they announced earnings, I believe, on Monday. They're projected to grow revenue by 4% in the upcoming quarter. That's not really great, but it's been typical of the last few quarters. It's not really a change. I'm just looking at the valuations. Bear with me a second. I mean, it trades at 27 times trailing earnings. Sounds a little bit high for a very slow growth company. I would probably lean towards selling it. I was in it and I got frustrated with the lack of growth and sold myself. So I just, like I said, I just don't think there's a competitive advantage anymore. There's so many companies out there that you can you get online meeting services from, and I just don't think they have the advantage that they used to. So I'm really not bullish on this stock.
I don't think I have I don't think I've ever even looked like at the 10K or anything related to Zoom. So I'll just leave that one there. A very quick question.
Oh, go ahead.
Go ahead. No, you go ahead.
They had some, AI tools look promising, but then it was stuff that other competitors can copy. So, I just don't see, like I said, I don't see anything where you can really gain an advantage by owning it.
Yeah, I'm gonna hit this really quick, and then I'll actually move on to a more substantial question. But Sadaf asked 8 minutes ago, you mentioned Bangladesh lately. It was in reference to, I think I was on and we were talking about like economic complexity in emerging markets. And I used Bangladesh as an example, especially its textile industry, where they went from kind of moving up the complexity of the textile industry and kind of creating this I wouldn't say cottage industry, but they've become a powerhouse in the textile industry. And I was just using it as an example. And Sadaf asked, "Do you ever considering investing in textiles? Some of the stocks are trading at half their net asset values, 3 to 5 times PE ratios." I have not. I'm gonna guess that most of the Bangladeshi textiles are probably trading on the I don't know how many of them trade on the U.S. market. I guess is the thing I'm saying. I'm guessing they're mostly on the foreign markets. I'm not afraid of foreign markets. That's certainly for sure. But this just hasn't been anything like I've really dug deep into any individual questions. So that was just more of like a representative example of emerging market stuff really coming up. But I can answer a something that's a little bit more substantial here. Let me see if I can find it. I've got it in my notes. It's on oil tariffs. Yes, Ed asked 4 hours ago, and Ed, I hope you're still tuning in so I can answer this question for you. Ed asked, uh, are tariffs good for U.S. energy and gas companies since foreign oil will be taxed? Maybe. One of the things is that I'm not 100% certain with is on this too is that yes, a tariff on imported oil would be inflationary. It would lead to higher prices, at least on a local market. One of the things that's I would have to double check, but I think on a net basis these days, I think we might be an exporter now. Between like stuff that is very, very light sweet crude that we get in, Texas is exportable versus most of the stuff that we import is a harder to refine crude. And so it's a little bit uncertain there because one of the things that like I said, we import these hard to refine crudes and export the easy to refine stuff because we built up the complexity in the North America's refining market specifically to do that. Those hard to refine crudes always trade at considerably cheaper prices than they do overseas. For example, the Canadian oil is typically the benchmark is called Western Canadian Select. This is basically the oil that Canada mostly imports or exports to the United States. It is a heavier oil, which means heavier means it has a lot of it has bigger molecules in it. Crude oil aren't all the same. They vary in the type of molecules and the composition of the oil itself. And so it can have really long chain molecules, what makes it heavy. And so they're harder to crack and to turn into usable products like gasoline and diesel. Tends to create a lot of like asphalt and things like that. But and it also has a high sulfur content. And so it takes a refinery that has the complexity to break down those really big molecules into something usable, as well as having like sufficient environmental standards to handle the high amount of sulfur. Western Canadian Select, as a result of, it's just oil composition differential. It typically trades for about $10 per barrel less than it does than West Texas Intermediate, which is the benchmark price for oil in the United States. So there's already a pretty large gap in terms of pricing involved. And it's been a surprisingly profitable trade for the United States, being able to take kind of the world's junk or the harder to refine, I'll call it junk crude, and then taking this very, very easy refinable crude like West Texas Intermediate and exporting it. It's basically can be as much as a $10 to $15 per barrel advantage for us. With a possible tax on that, or tariff, if you will, it could have an impact. But considering the price differential already, it might just bring it up to WTI, and I don't see a place where like refiners in the United States are going to significantly change the composition of their refineries to this adjustment. For one, we don't know if these tariffs are going to be permanent. If we have this on again, off again relationship where, 1 month where we put them on for a couple days, come to an agreement, turn it back off again, things like that. It would not make any sense for anyone in the refining industry to change their purchasing habits. And so maybe it might do better for some of the producers. Maybe, I don't know. It depends on like what they can get in the foreign markets anyways, because if we see, demand changes overseas, that'll actually probably have a bigger impact than on the tariff end of things. For the I would say probably the ones that would actually be impacted the most would be the refiners, because it might close that, spread gap between the pricing of the crude oil, which would hit their profitability unless they could pass that on in the form of higher gas prices.
Yes. Okay. So Bessie's asked 9 minutes ago, what stocks are best to rotate into in the advent of growth slowdown and recession? Can you give some examples? That's going to go into personal advice in many cases, and really you're just how you're going to handle a growth slowdown and a recession with regards to your portfolio is going to depend on you as the investor and what stage of investing you're in. Now, if you're nearing retirement, obviously you want to look at more yeah more of these stocks are less affected by recessions, and maybe during the recession, things that are food stocks, medical stocks, anything that serves the government. Those are pretty steady regardless of what the economy is doing. Energy to an extent, but then energy usage does fall, so it's not necessarily energy per se, but those stocks will do better. I typically don't sell off stocks even if I see a recession coming. I tend to buy stocks that I think will do well over the long term. And yes, maybe they are affected by some of these economic cycles in the short term. I'm in some semiconductor stocks, and the semiconductor industry is notorious for its cycles. So usually, in most cases, I ride those out. I don't really change my investment portfolio or sell stocks unless I see a breakdown in the investment thesis. So I tend to handle these by just writing them out. But during recessions, like I said, stocks that companies that don't see a reduction in revenue because of a recession, like food stocks or government service stocks. Those are the ones that typically will be least affected by a downturn.
Yeah, I'm very curious. Again, like this is not personalized advice. This is purely for educational purposes only, and we're just here to share our thoughts and our personal opinions, and don't want to misconstrue this as giving advice to you directly. But the thing that stood out to me in this question the most is the word rotate, which is kind of this insinuation of selling some things to buying into other things, and often some of the biggest mistakes that most investors make, like the regular individual retail investor will call, is being too active, too much trading. That minute that you rotate out of something to get into something else, you immediately have to pay a capital gains tax. So whatever you did, you're already having to like take some out of the kitty to pay the tax so you can make a move. It's a friction point for you. It should be a penalty for doing this. Part of the reason that investing in businesses works so well over the long term is doing nothing. And so trying to be super clever about it, sometimes you can just trip over a dollar to save a dime here, because you're cashing out a huge position to move into something else. You're going to have to pay taxes on it, and then hope that like the recovery that you make in this other position is big enough to recover the taxes that you just paid on it, on top of whatever gains you may have gotten with the position that you sold. From my personal perspective, again, I don't normally sell any companies based purely on macro reasons. It's going to be some sort of merit to the business itself. And in terms of slowdowns and recessions, that's it's the biggest reason why, at least me personally, I do always try to keep a decent cash cushion, even when the times are good. There's that greed component when we're in bull markets, when things are going great and everyone's making money, and like, oh my goodness, Bitcoin's going to 100,000, and companies are trading at 150 times earnings, and growing at 60-70% per year over a couple of years. And there's that like, oh my God, I need to get into this. And eventually as the things start to slow down, you find yourself with absolutely no cash available. So when the pricing opportunities arise in slowdowns and recessions, you don't have any capital to deploy, and you have to resort to that rotation, where again, pay the taxes on it to actually make the move. So that's part of the discipline of being a long-term investor, is having the I guess the brakes applied enough in the really good times to have enough cash when you get to that point of slowdown recession, that you can allocate to the positions that you want to allocate to without having to make significant portfolio changes.
Yeah, I'm glad you brought up that point too, because a lot of this is trying to time the market. Timing the market is extremely difficult. I myself am a very poor timer, so that's one big reason I
Can,
don't try to sell in these
can we
situations.
name anybody who's a good market timer? Like, I don't think I can name anyone
Yeah,
over
not
like the
really.
history of investing.
Yeah, that I'm at a loss too. That's a good point, but you kind of feel it though if you really try to time it. It very rarely works from my experience.
So Vihan asks, this was just 8 minutes ago while we were ranting about rotations. Thoughts on Occidental Petroleum at its current valuation? So I actually have to look up its current valuation because I hadn't checked it this week. Obviously, one of the reasons that Occidental Petroleum gets a lot of attention is because it is in the Berkshire Hathaway portfolio, and it is one of Berkshire Hathaway's largest positions. I think they own, between like warrants and preferred shares and its common stock holding, they own, it's less than 50, but it's like in the 30s or 40s. It's a lot. And Warren Buffett has certainly uh, professed his affection for the business, and Vicky Hullab, the CEO, in leadership. I know I'm committing a little bit of investor heresy here, but I never really saw the appeal in Occidental Petroleum relative to what Warren Buffett saw in this particular company. I think he got a very advantageous time to buy into the company. The Occidental Petroleum had made a very, very large acquisition and didn't have the financing available to do it. So went to Warren Buffett. That's how he got like these 8% perpetual preferred shares that, pay a lot of money in cash. And, some of that's converted away now, but, those are the kind of deals that you and I can't get when it comes to investing in things. Like, they come to you and be like, yeah, we'll give you 8% preferred perpetual stock, while the rest of us have to buy the common stock. And, I just, number one, it's a mostly exploration production company. I know they have a small chemical manufacturing side of the business, so they're kind of an integrated oil company, like the Exxon Mobil's and Chevrons of the world. But the chemical side of the business is so small that it barely like registers relative to its oil and gas production. Its oil and gas production is fine. There's some decent production there. Its cost basis is pretty low. It has considerable operating efficiencies because it is heavily leveraged to the Permian Basin and has a large continuous acreage there that allows them to make more efficient drilling. Like, when you have continuous acreage, you can tend to like drill laterals for shale that are considerably longer. Longer laterals tend to be more profitable because you only have to drill it once instead of 3 times on a smaller acreage holding. You can consolidate your infrastructure into a single place, and you can plan out the development of the acreage considerably better unless it's like versus being like pockmark, where you have some acreage here, some acreage there. We kind of have to tie it all together, less efficient. So there's a lot of things about it that, for exploration production, it's fine, but I've never been too excited about exploration and production, period. And the company has been very aggressive and tends to like get into these big it kind of, I wouldn't call it a binge on debt, but they make these really big swings and then they have to pay it down. And if you make a really large acquisition at the wrong time when the market it declines, you can get caught with your pants down. And it happened to them once, and that's why Warren Buffett got involved with them so much. And even at 22 times earnings, 1.9% dividend yield, I don't know. I've never been too excited about owning exploration production companies. Instead, I tend to look at refining and master limited partnerships. For which is basically oil and gas pipelines. Actually, two of my largest positions. My largest publicly traded position is actually a master limited partnership, MPLX. That's both the name and the ticker. I think they're some of the best capital allocators in their respective industry, and midstream companies tend to be much more steady. Based their prospects are much more based on capacity utilization. So that's like volume of product moving in their systems versus actual commodity prices. Their commodity price exposure is quite minimal. And so when I'm looking at this industry, those are the two places I tend to go to more so than others, is midstream and refining. I think they're just they tend to be much more stable, cash generative, and good at creating per share value.
Yeah. So Besties asked 26 minutes ago, is the market going down like in 2022? Then rising interest rates did it. Today, what would do it? Stocks, and he's asked stocks are stocks better in a recession or if inflation rises? Again, like I said a few minutes ago, I'm horrible at timing. I think we're all not so great at it to an extent. So the short answer is I don't know. I mean, and really anything can trigger it. I mean, you just look at all these earnings reports, for example. Sometimes a stock went up just because some obscure metric was higher than they were expecting. Other companies seem to offer an almost perfect earnings report, and they fall after. So there are a lot of factors go into that. I think Nvidia was an example where their earnings report was nearly perfect the last time, and the stock still went down immediately. So you just don't really know. I mean, there are some causes to worry. For example, the Shiller PE ratio, which is the price of the S&P 500 divided by the average adjusted earnings for the last 10 years. That's at 38 now. That's not a record high, but it's near historical highs. So that is concerning. Also, you look at Berkshire Hathaway, Warren Buffett's company. They're now holding $334 billion in cash. So there could be a lot of reasons for that, but I'm struggling to find a reason besides we can't find anything that we want to buy. I think Berkshire bought some Sirius XM, but that's only an $8 billion company, so that was just a fairly small share allocation. So when you're talking about $334 billion to invest, that's a drop in the bucket. So not only does Berkshire have to find something that's investable, they have to find something big enough where they can deploy a significant amount of their cash. And there's not a lot of opportunities there. That could be bearish, but I'm not going to predict when the market's going to come down, but it works in cycles, so it will at some point. But the question is when, and we just don't know that.
Yeah, there's actually the interesting part of this question, at least for me, is today what would do it? As if kind of the what is the catalyst that would cause a market crash or something like that. And one of the things that I always find interesting about this is often the market tends to fight the last battle versus the current one. I've been doing this for about 12 years or maybe 13 now. And one of the things that you would see in like the early 2012, 2013, 2014, everyone was still freaking out about mortgage delinquencies. They were still freaking out about basically the other shoe to drop in the housing market. And this narrative stuck around until like 2017, 2018, even though default rates on mortgages was just declining precipitously. And today, through like 2018, 2019, and onward, we've had some of the lowest default rates in America's history. And so it's interesting to see, like, we often get so fixated on previous reasons that the market crashed that we sometimes don't, or recession, bear market, whatever you want to call, like, the reason something happened, we get intensely focused on the thing that happened before and are constantly on the lookout for it, but don't. And then it's the thing that we're not paying attention to that tends to be the catalyst. And so, I we could probably all ramble off like 4 or 5 things of what could do it, but in all honesty, it could be anything. And that's the heart of that's what makes these things so unpredictable. If it was just rising interest rates, that's been something that's been a conversation for a while now, because inflation's been a little sticky, and so inflation, or interest rates, excuse me, have been something that has been a lot of people's minds, and the market tends to, I don't want to say the market has it priced in, but people who are in investing are acutely aware of these issues. It's when it's the more unexpected sort of declines or news event that tends to be the ones that catch us off guard and lead to more, I'll call it, like, higher drawdowns in bear markets.
Yes. So, Vihan asks, gentlemen, based on earnings to date, name 5 beaten down stocks which look intriguing at current valuations. Well,
that's a lot. Do you want to? I was gonna say, do you want to split that up? Five from each of us is a lot. Maybe if you want to take 2, I can take 2, because 5 is quite a bit.
Yeah, that's fair. I could do 5, but I'll let you throw in a couple, 2 or 3. Well, I about a month or 2 months ago, I bought both Celsius and Realty Income. Realty Income's the symbol O. It owns single tenant properties for commercial purposes. They own about 15,500 properties. The stock's been beaten down because of the high interest rates over the last few years. It still trades below its 2020 price, but the business itself has grown during that whole time, and the stock's been so beaten down that their dividend, which is paid every month, by the way, is now at now just under 6%, and they do raise it a few times a year. Those raises are nothing to really write home about, but at that rate, I like it. I think once some of the interest rate pressure comes off, I think the stock will rise as well. And then I mentioned Celsius, both I think just now and in the last hour. It's been beaten down because they had that inventory issue with the distributor, where the distributor wasn't buying as much inventory. I think that's going to be a temporary problem, and they just had that acquisition as well. They were up more than 30% after they announced earnings on Thursday, probably because of that one acquisition. I think Alani Nu is the name of the competitor, but they're in similar parts of the energy drink market, so I think that particular merger makes sense. I also think there's huge potential internationally. Their international revenues only is less than 10% of the revenue right now. So I think as they ramp that up, that's going to be a bull market for them. They are still they're still suffering from the inventory issue. Their revenue was down modestly, but I think that one is one that will go up over time, and or maybe PepsiCo, which is their major distributor, pretty much. They may buy them out too. So I see a lot of potential for it to go up from several different scenarios. And I guess you want to go ahead?
Yeah, I'll go. I mean, I can do beaten down, but man, you're going to feel ugly wanting to buy these because it's cyclical industries, and oh boy, they are beaten down right now. The 2 industries I've been looking at the most are home builders and solar. I think these 2 industries have seen some considerable declines and are starting to get priced at levels that I find very attractive. I know that home builders, I think, is still going to be pretty ugly. There is legitimate concerns on, labor availability, lumber tariffs, potentially higher interest rates throwing more sand in the gears of the housing market. There is a lot of negative news surrounding home builders, and some of the earnings reports that we've seen come out so far, you're starting to see like modest declines in backlogs. So future work coming in has not been too robust, and so there might everyone is pretty on high alert in the housing industry for these issues. I don't know if they're going to be abated this year. They might not. But one of the things is with this industry, there is like long structural reasons that home builders are going to exist. Home builders outside of the Great Recession have been very good investments. It just happened to be that the Great Recession was like the thing that, was like the giant meteor of death for the home builder industry. And so I think they're a little bit more resilient than a lot of investors give them credit for because of the Great Recession, which was like a once in an 80-year sort of event in terms of market downturns and economic downturn. So housing, home builders, two companies that interest me a lot in this industry right now are NVR. They're obviously, I think, the best operator in the entire business. I think they actually are run by the board. And the other one is Green Brick Partners. They're a much smaller one, but everything, I own them personally, and they are kind of like, I think, in my opinion, they're the best underwriters of the publicly traded home builders. And then on the solar side, a lot of political concerns on, going away from renewable energy and all that stuff. I maybe, but there hasn't been as much chatter on, solar being a huge issue. I think that's been a little bit more concentrated on the wind side. And so you're getting some pretty interesting companies at good prices. First Solar is down at like nearest 52-week lows. I think it's trading at like 15, 16 times earnings. I have to double check that just to make sure that I'm right on that regard. But another one that I recently purchased was Canadian Solar. Not quite as quality of an operator because they have a development arm, and so they go through these periods where they have to take on some debt and hold these like big assets on their balance sheets. But Canadian Solar currently trades for 0.3 times book value. Unless there is like a 70% write down of its balance sheet that I don't see right now, I think that company looks trading at incredibly low good prices. And First Solar currently trades for 13 times earnings. So I think those are some very interesting industries if you're looking for beaten down.
Yeah, and I'd also be remiss if I didn't mention advanced micro devices, symbol AMD, and usually called AMD. It's trying to compete with NVIDIA in the AI accelerator market, and their data center segment, which is the AI accelerator business, basically is about half the revenue now. I think with this DeepSeek breakthrough, democratizing AI to a large extent, I think that's going to be bullish for AMD, and their stock is down about almost around half from last March. I could be wrong about the percentages, but it's approximately half. Their forward PE ratio is down to 23, which for a faster growing semiconductor stock, that's very cheap. So I would definitely have AMD on your radar. I'd recommend adding shares. I'd be adding more myself if I didn't already have some, but I think that one belongs on your list as well.
So we were having I mentioned a little while ago, we were like pipelines, MLPs, things like that. And there was a question a couple days ago that I think, I hope, Richard O, you're either on or you be able to get the recording for this one. But he asked 2 days ago, can you discuss the tax advantages to owning MLPs such as the ticker EPD, which is Enterprise Products Partners, which, considering I mentioned it as one of my preferred places to invest in energy, I thought this would be a good follow-up question. Master limited partnerships are a different beast when it comes to investing in stocks, because it's technically not common stock. It is it's an ownership in a partnership, and what that means is instead of the partnership itself paying taxes like corporate taxes, you as the part of the partnership, you actually have to pay your portion of the company's taxes using your individualized tax rate. and as a result, that's why we have these large distributions, because they're paying out to you so that you can pay your portion of the taxes available. Now, often the taxes that you pay are considerably less than the distribution, and so that tends to work itself out in the wash, or at least it works out in your favor. There and as a part of it, there, you get to capture some of the other benefits that are involved of having, a K1 instead of which is a form that you get at the end of the year as a partnership owner versus, your typical 1099 for a dividend. What some of the downsides, I guess, for it is that because it is a partnership and it's already a tax advantaged entity, you can't put it into retirement accounts because that's like a tax advantage thing on top of a tax advantage thing, and the IRS code doesn't necessarily like agree with that. It has a thing what's called unrelated business income tax penalties. So these are entities that you don't want to own in a retirement account. There are some partnerships that are okay in retirement accounts, some that are not. It is actually most of the companies that with this will say in their investor relations page whether or not it the partnership that they have can be qualified for it can actually qualify for tax advantaged status or anything like that. So if you're considering these, just take a peek at what that means, and then and I think that's pretty much the rundown. Basically, you get a huge headache at the end of the year because you have to like do some unique tax paperwork or hand it over to your tax preparer, and they'll do it for you, maybe for a little bit extra fee. But there's you get the advantages of depreciation, you get the advantages of paying at your personal rate versus like the corporate rate plus an ordinary dividend tax rate, and that's why we tend to see higher yields in this business, because they pass along that tax savings to you a certain degree, and higher yields also because it tends to be a slower growing industry that throws off a lot of cash. And so I think that covers most of the questions for MLPs. If there's something else, I'll try to remember.
Okay, so about 55 minutes ago, Vihan asked, gentlemen, what kind of stocks do you like to build in a Roth, meaning a Roth IRA, with limitations of capital, volatile small caps transition to mid cap, or mid caps to large cap, dividends? I'm just throwing out a lot of different types of stocks you could pursue in a Roth. Um, Roth is obviously more for retirement. I might be a touch more conservative with the Roth. I don't really look at it in terms of small, mid cap, large cap, dividends, etc. If I like the opportunity, I'll go into it. Now, if I think the opportunity is more speculative, I will typically not use Roth money to buy that. Well, I guess that I made some exceptions, but most of the time when I'm speculating, I don't. I use that with money outside of a Roth and just in a regular brokerage account. Yeah, as for the limitations of capital, when you're first starting out, that may be an issue. In that case, I might lean toward ETFs, so you could invest in more stocks. We here at the Motley Fool recommend around 25 stocks, but if you have a $7,000, if you donate the full $7,000 a year to your Roth as your first year, you may not want to divide that by 25. So I would recommend going into ETFs at first. As that builds up, though, you can go. I think one can feel more comfortable going into individual stocks. And then when you're getting closer to retirement, you want to maybe take it more conservative at that point. But I don't really, in general, I don't really invest it too much more differently, except like I said, just be a little bit more conservative with the Roth. That would be my advice. But to me, it's just another investment vehicle.
I'll just share my personal utilization of Roths and thing like that. I have a Roth as well as a IRA and a brokerage account, and then children's accounts aside from that. Both my retirement or tax advantaged accounts, the Roth and the IRA, I tend to get over allocate to dividend stocks in these things, because I'm well, I'm 40 now. Happy birthday to me. Well, that was a couple months ago. But so 40, I've probably got 20, 25 years, unless I'm really lucky, of investing. And so that's a lot of dividend stream for a very long time. And, the power of reinvested dividends has shown to be a very good accumulator of long-term wealth. And so as I'm looking to make capital allocation decisions across all of my portfolio, if I have businesses that pay either high dividends or fast growing dividends, I tend to put those into my retirement accounts just to get the tax advantage on that side. And then, like I said, the one exception of that being the master limited partnerships that I have to keep in my brokerage, so I don't run afoul of the tax man.
Yeah, that's a good point about dividends, especially if you've been in dividend stocks that have increased their dividend for several decades. Dividend kings, or that certain type of very noble dividend stocks I can't mention the name of, but or just ones that aren't in a category that have increased their dividend for more than a decade. If you receive the dividends, invest the dividends, and reinvest the dividends, that can really grow your portfolio pretty significantly over time. So I think that's a great investment strategy for something geared towards retirement or college savings plans.
It's really fun when you have dividend stocks in your portfolio for a really, really long time, and you can go and look at the buy sell list on that thing. Like, you go into your brokerage and it'll show you like when it was bought, and you get a they'll show you a buy notification each single time that you do, the dividends come in and get reinvested. And it's really fun going from like watching it be a single digit to a double digit to a triple digit to maybe 4 digits on top of it. It's a very satisfying feeling watching that amount grow over time.
Yeah, and going back to Warren Buffett and Berkshire Hathaway, they've owned Coca-Cola for, I think they made their last purchase more than 30 years ago, but just
It was
because
in the
the
mid
dividend
90s.
yeah, and just because the dividends goes up every year, their return on the dividend alone is about 60% or around there on their original investment. So in that case, they don't reinvest the dividends. I guess they don't like Coca-Cola as much as they used to, but I think they keep it for that rising dividend income, certainly.
Yeah. I had some leftover questions that I wanted to hit. I'm trying to find it, make sure that I can get it. Apologies for the bad radio when it comes to this stuff, but there was a question in here a little while ago. It was from Matt, and it related to Prologis. I'm trying to find it. So let me see if I can find the exact question. There it is. 4 hours ago, Matt was asking Jason, but I'm going to steal this from Jason. I don't think he'll mind too much. Other than maybe Prologis, what are some REITs where growth of the dividend is a greater priority for management than servicing the debt of the business? I think there's a lot of them actually, and it tends to be more on. I don't know if servicing the debt. I think that might just be kind of a reference to where we have higher interest rates. Refinancing debt has been a major question for a lot of REITs who are trying to, probably were a little bit more leveraged than they should have been for a publicly traded entity. As interest rates started to rise, the low interest rate environment for the previous 10, 15 years did wonders for them in terms of growing their businesses, but higher interest rates make this a little bit more challenging. But I tend to actually divide REITs less in debt servicing companies, and there's like the empire builders versus the actual per share value growers. There's a lot of people in the REIT business who just grow the portfolio for the sake of growing the portfolio. They want more they want more buildings, they want bigger numbers every single quarter in terms of like growing their funds from operations. But what ends up happening is we grew our funds from operations by 17% year over year. But then you look at the income statement, and it's like, well, the funds per operation per share only went up like 2.3. And so, that's not exactly the most value accretive trade for most investors. So I'm going to, that the companies that are really good at growing per share value tend to be the ones that grow the dividend quite well. And so, one company I want to point out in this regard, I think is one of the better in this industry in terms of growing per share value, is Terreno Realty. They, like Prologis, are a industrial real estate company, but what they do is instead of trying and being a giant like Prologis, they are much more focused and tend to only operate in what they call gateway cities. Gateway cities in the United States tends to be like the largest ones that we have. Seattle, Miami, Washington, D.C., New York, Los Angeles, and I think, did I say Seattle? I can't remember. And the idea being is all of these cities and the metropolitan areas have what is called shrinking supply from zoning. They're taking industrial real estate zoned areas and repurposing it into commercial or things like that. So you actually have a net shrinking supply of industrial properties in these areas. And so as a result, you get pretty high premiums for your rent. You can grow rent at much faster rates in these markets than in parts of the Sun Belt where land is bountiful and things like that. I'm getting the producer in my ears also mentioning that they have a lot in the San Francisco, Oakland Bay Area as well, because that 6 markets and that's all 6 of them. And this business is basically, in my opinion, one of the best managed. Management is intensively focused on per share value growth, which tends to do well when it comes to dividend growth as well. And just as I pull up the dividend growth over the past 10 years, this is a company that's grown its dividend by 12% annually. And, the most recent one was only 10, as we are facing a little bit more of the, what we'll call them, interest rate headwinds. So kind of pretty par for the course for a lot of people in this industry, but you're still getting double-digit dividend growth for a business that is just, I think, really, really good at growing the per share value versus just trying to get bigger.
Yes. So we're at the top of the hour, actually a little bit past it now. So I think Austin is going to rejoin us.
I had a little bit too much rambling at the end there, and I'm sure Austin was like, "Let me get in here."
Oh, you were on a roll.
No, all good. I did that to you last hour, so I was thinking this must be payback. That's all good.
Full on, guys.
Good to see you.
Thanks, Will. Austin, good to see you again.
Good to see you, Tyler. And I see you guys made quick work of the queue, so that's always good. And there was a question in the queue from 4 hours ago that I saw, in the spirit of you grabbing a question from Jason. And I'm going to take a stab at answering this. This is from Jeff Warden. Curious if you have any thoughts at all on this. In the interest of non-U.S. equities, how do you view the Indian market given potential further Chinese monetary easing, short term and 3 to 5 years out? Yeah, so Jeff, I'm very interested in foreign markets. It might have been the last time Tyler and I were together where I expressed my admiration for everything the U.S. markets have done, but also my concerns of the concentrated capital that's flowed into the U.S. market over the last couple of years, and how so much of like global market capitalization is just concentrated here in the U.S. And so we've gotten off to a shaky start. Couple of months into the year now, the S&P 500 is slumped a little bit in the last week after hitting all-time highs, and Friday was another day which just felt very difficult on a lot of fronts. And I note, as many of you have also done, that conversely, foreign equities many of them have done pretty well since the beginning of this year. So the S&P 500 is trailing many of the indices it's been leading the last couple of years. So I won't get into the short-term reasons for that or what I think they are, but we'll look forward. I think for me, the Chinese market has had a question mark around it for several years. I may trace this back to 4 or 5 years ago when 2 things happened. The U.S. really had issues on a regulatory level with the information we were getting from Chinese companies. And there was a little bit of a brouhaha with the SEC on being able to trace like ownership of Chinese companies, the veracity of some of the data that was in filings. So there was back and forth between the two countries on that. And that actually led to a not great listing climate for Chinese equities in the US. So an investor who wants to participate in China is still, for the most part, left investing with the American depository receipts of Chinese companies or investing directly in the Chinese market through a brokerage which allows one to do that. The second thing, which I think put a pall over that market, is of course the government policy, which is shifted a bit towards what the government believes will be the drivers of the economy in the next several years, and that moved away from what had driven the market higher in the preceding years. So these big consumer tech-facing companies like Alibaba, and gave more freedom to industrial-based companies who are trying to operate at scale, and also incentivized like the electric vehicle in China to do what China does really well, which is to mass produce and use government incentives to enter new markets at reduced cost. So having said all that long preamble, as you can probably tell from my voice, I'm a little skeptical about the ultimate ability of the Chinese market to generate a lot of value. Some things are coming full circle. Alibaba is doing well this year. Jack Ma was pictured with the Chinese government leadership. So he's back in the good graces as they are understanding that artificial intelligence is going to be important to their future economy. But I think it's a hard place to invest personally. Curious what Tyler thinks on that, given his background as someone who's also aware and interested in global equities. Indian market, I invest in the Indian market. I'm of Indian extraction myself, so I am aware of that market, and I've watched folks from both sides of my family, my own and my wife's side, successfully invest in this market for years and decades. But you have to remember with the Indian market too, like the regulatory atmosphere there is weird. Like the Indian bureaucracy is very difficult to work around. It's flighty. Sometimes the Indian government, just on what seems like not very substantial grounds, takes issue with foreign companies and will tax them or investigate them. Having said that, there is a shift, definitely, when you look at the emergence of this flow of supply chains outside of China into Vietnam, Thailand, Japan, and India. There's a burgeoning little semiconductor market there now. So I think that market has potential. Near term, volatile. It's going to be volatile. The long-term trajectory is good, but one thing you have to watch is the rupee, just because of government policy and the way the economy is structured, never seems to gain any ground on the dollar. When I was a kid and went to India, the rupee was trading at 7 to $1. And that was a lot. It seemed like that was such a weak currency. Today, it trades at something like 86 rupees to $1. So the long-term potential of that currency should be going the other way. If you invest today and hold something for 10 years in an investment that's denominated in rupees, you should do better, right? And for many reasons, which again, it would probably take the whole hour to have this discussion, it goes the other way. I think that's something that is probably okay long term. Okay, last thing I'll say about this is, the Indian economy, any economy you look at from here on out has to be analyzed, not just in terms of all this like industrial stuff and government policy and tech, but also demographics. Chinese has an aging population. The US has an aging population. Not, again, we don't talk politics here, but I will say that we're getting older as a society, and we're also our regulatory bent now is not regulatory, but policy bent is towards slowing immigration flows. And in countries like India, the population is so much younger. So places to look for investment, if you're going decades out, I think India and Africa are interesting markets for that reason alone. Okay, enough said. Tyler, any thoughts on this question?
You kind of you danced around it a little bit with the comments on aging population in China, and that's something that has made me very hesitant about anything in the Chinese market. Some of the official statistics are showing a declining total population, and birth rates there are not doesn't look like that there's going to be a sharp reversal of its aging demographic anytime soon. And so there's part of me that wonders, excess capacity, things like they'll make it challenging because even if it's just flat population and no growth, that basically relies, all your GDP is basically growth is like higher productivity from workers versus just more people participating in the economy and things like that. So that's a very high level thing. Obviously those things can change, but that's the thing that's made me a little bit cautious about anything in China today. And far as India, I find myself picking spots. One of the industries that really interests me is the generic pharmaceuticals industry. That's like has a very large presence in India. They kind of established a bit of a cottage industry there in that, and there's a lot of companies in that sector that have done incredibly well, and so something that I follow specifically in the Indian market, but outside of that, I don't have as much knowledge on the Indian market. I will take note that for a lot of the reason that people are looking at international markets today is because of valuation, because like you had said, fund flows have been mostly going into the US equities because they've been doing so well, have high valuations. India does have one of the higher valued foreign markets out there today relative to everything else. I'm looking at a research note from the London Stock Exchange Group, and the latest trailing 12-month forward PE for, the 12-month forward PE for the Indian market today is something around like 22 versus a lot of other emerging markets today where you're in the 10 to 15 PE range. So you're pricing in a lot more growth in the Indian market. And, I guess that, kind of have to weigh that a little bit because, a 10 PE market or finding companies in markets that are beating that down, it does not take a lot of growth to generate sufficient returns. You start getting into the 23, 25, 30 times earnings range. It requires much more growth. And so I don't know if I would want to indiscriminately be buying Indian equities at current valuations, but as the case is with the American market too, there's always pockets of places to invest in any market, and to like make a blanket statement about like, don't buy China because of this or buy India because of this. It's all going to come down to the individual companies that we're assessing.
Yeah, I totally agree with that. And I would say, so pointing to something that Vihan sent in the meantime. So this is Aswath Damodaran. He's a very famous valuation expert at NYU. He says India is the most expensive market. No amount of hand waving can justify its valuation. The article that's in the Slido, you all can see it. It's very good. It's classic Damodaran. There's a premium to the Indian markets, and he's pointing out, I think, what is reinforcing Tyler's point that you pick and choose companies you would invest in here. I would say, for myself as an investor in some Indian equities, and again, having studied this market, there are some reasons to accept a premium if you are picking those spots. And one of those is what's pushing the valuations up are two things really. It's an acceleration in technology and Indians companies using technology to their advantage. So they're becoming more profitable. If you look at the average rate of generation of profits and cash flow today versus 10 years ago, the prevalence of cheap and intelligent labor in India, like many companies use here in the US, is having some multiplier effects there. I think companies are more profitable pound for pound. The second thing is just a wave of middle class people who are entering those markets for the first time. The middle class in India, again, is the size of the US population, and that's growing. And so they are learning to invest. They are, some of them are generating enough income to have a whole investable amount. And they're in some regards chasing the leading names is what I've noticed. So it's an interesting perspective there. One of the things that I've taken away from Professor DeModern, and he comes and speaks to the Fool analyst every so often. He spoke to us a couple of years ago um, in a session and told us, look, if you're valuing one equity, you can actually prepare for a range of outcomes by using something like a Monte Carlo simulation, which is like a random simulation. He's like, be prepared for like a wide event horizon because your assumptions can be wrong. He's great at like really enforcing this idea to have a narrative to marry up all your spreadsheet discounted cash flow stuff, which he's like one of the best in the world at, with a solid narrative that makes sense. And he's the first to admit that, your assumptions could be wrong going in. So I like that probabilistic approach to valuation. And it makes someone like me who, if I can find a company that's worth holding for 10 years, I actually will pay a premium today for it. Not a huge premium, but I don't mind paying up today if I've got a good sense it could be very important 10 years down the road. And I look at the Indian market like that. I look at the markets in Africa to some degree like that. I have a feeling that it would take a lot of time to you just pick one market. Africa is so huge to understand it, right? The Kenyan market, like how much effort is that going to take? We need a Motley Fool service to tell us where to invest in Africa. But this is sort of the thing that I would be doing. And this is a long way to say exactly what Tyler is suggesting, is to look at the big picture and then choose wisely in there. You can go into the best, most promising markets and overpay to your detriment.
So since we are talking about international markets and maybe venturing a little bit further away than just the American market, and also mentioning Aswath Damodaran, he has a great Substack where he does a lot of like updating his valuation models and things like that. And he does a fantastic paper every year on individual country risk. Basically looking at political stability, looking at credit ratings. It's a wonderful paper. I put the link for it in the Slido. If you have any inkling about investing internationally, this is a must read. I every year that I think he updates it in the summer, like when he's off from his teaching role, and I read it religiously every year because it paints a really interesting picture of not just like, the markets that we would think would be places that people would invest, America, Canada, London, Paris, and things like that. But there's also like some, markets that you wouldn't think in there that you're like, that is a surprisingly, robust market in terms of, credit risks, in terms of political risk, in terms of like the regulatory requirements for listing companies and disclosures and things like that. So I would encourage anybody who's listening to this, because clearly we are all stock junkies here and investing junkies.
This is the kind of hour, paper. I think they're coming out of the woodwork, and amen to that.
And,
but keep going.
So this is definitely a stock investor junkie paper.
I think that's an amazing piece of advice. I'm glad you shared that. And this paper is like renowned because people like tweak their models for the premiums that are listed in this, if this is what I think it is, and chase the link yet. But yeah, there's certain people that I look at like, okay, if you had to live life again, Asit, and it was basketball, who would you be? Michael Jordan. If it was chess, who would it be? For me, Garry Kasparov, right? Finance valuation, Aswath. But that's just me.
Yeah,
there are other stars.
That's pretty fair. Yeah.
All right. So we've got lots of questions that have come in. Thank you, everyone. Let's get start from the top. So, some nice conversation starting. Merton Carlson says, I question the demographic problem with China specifically and the world generally. Do we need more creative economic models for population flatlining? So I'll take a first quick stab at this, Merton. I think, I interpret your question in many ways. One of the ways I interpret it is to say, hey, okay, yeah, like populations are getting older, but there is a lot of innovation out in the world, and the models aren't perhaps capturing productivity. Do we really need, uh, a growing population in order to have economic growth? I think that's a good challenge to what I was saying. My small comeback vis-a-vis China for that is that the way the economy is structured, it's really imbalanced right now with the amount. If you just project out, okay, not a few years, let's project out 10 or 15 years, the amount of supposed GDP that the newer population can provide versus a population that right now has one of the earliest retirement ages around, that there's an imbalance there, and the benefit system there is not as bulwarked as it here in the United States. It's another issue there. So it almost appears that, and without, again, I'm an armchair expert, so I'm not an expert in demographics or the Chinese economy, but I will say it appears to a casual observer that the younger generation is going to have to do a lot of work, labor-wise, productivity-wise, to support that. Now, generally around the world, I think it's a great question, and I think we do need more creative economic models. There's so many ways to look at this question. There's a great scholar that I follow, Dr. Alice Evans, and she writes about one particular problem with global GDP, in that the output of women in the labor force, for so many reasons, is diminished, and it shouldn't be. So forget technology. I mean, there's one lever right there that could be adjusted. So great question. Tyler, any thoughts on that, or want to move to another question?
The only thing that like you were getting as you were considering the productivity growth, that's the one thing, like the most basic equation, like as complex as GDP growth is, right? It basically comes down, you can boil it down. And I think I'm actually, if I remember right, I might be stealing this from Morgan Housel. I can't remember. If I am, I apologize.
Steal from Morgan.
Yeah.
Fine. If you steal from someone
listening.
who's not wise,
yeah,
it's not helping you or me or anyone watching. But if you steal from a guru, that's okay. Yeah. And I like this upfront.
I think this was actually when he used to. I think this is when he used to write for us, like back in like the mid 2010s or something like that. But kind of boiled it down to two things. It's basically like it's population growth and the productivity per person. And so like those are the two levers you can pull for GDP growth. And in a flat to declining population, you have to offset it with productivity. That's entirely possible, right? Like we're talking about AI assistance. We're talking about all of these ways that we can basically juice, economic models to increase the productivity per person in any economy. And, we could see a stepwise function increase in China and basically worldwide on the productivity end of it. But the population thing is always going to be a component of GDP growth. And, I guess we can, create more creative economic models, but those are the two things that we're trying to capture.
Okay, so we've got a question from Matt. Said, Tyler, would you call Pitney Bowes PBI a value trap? And Matt, I know you've asked me this question in another venue probably a year or two ago, so I'm commending you on following a company for a long time. I don't know if you've invested in Pitney Bowes or have just been sort of scratching your chin looking at it. Should I invest in this? Is it a value trap? I had done a quick run through at the time you first asked this question, and I'll be honest, I really don't remember the details, except that I actually was in the print industry myself for a while. They're loosely correlated with the print industry even today. The technologies, adjacent technologies. Yeah, I felt that the problem there for me when I looked at it was I couldn't see like a substantial increase in free cash flow. I don't know if what's happened in the intervening couple of years, but I just want to draw this out as an example, since I haven't followed it closely and don't have time to take a deep look now and give you an informed opinion, is to say that to me, looking at value companies, I almost always just focus in on that ability to change cash flow, because most of the time a company becomes a value proposition because of cash flow. Because going back to Damaradin, investors expect that the future cash flows are not going to be what they were expected to be. And that's why the price has been adjusted down. At one time, cash flows were expected to be X. Today, it's a value stock. Shares have gone down because investors have readjusted those expectations. So that's the first place I start with any value proposition. Okay, if I had to dream this out 5 years or 10 years, 10 years being a typical time that an investor might do a discounted cash flow analysis. I don't like discounted cash flows. I'm good at math. I'm bad at assumptions that go into the model, so my outputs are never that great. But yeah, I would think so that the larger thing I would want to extrapolate out of this is, if you're still looking at it, try to figure out what you think are the catalysts that are going to change the cash flow projection. The other quick point, and I'm curious about Tyler's general thoughts on this, or maybe he follows PBI, is that you sort of have to understand what can change. You have to really understand, again, going back to narrative, what could be different, and assume that the market is right and you are wrong. That's my starting place, because there's a lot in conventional wisdom. There's a lot in crowdsourced wisdom. And if contrarian was always a contrarian view is always a successful view to implement, then we'd have, just this weird flatlining because everyone would be a contrarian. So I believe in wisdom of the crowds. I love it when I can go against it and I'm right, but I've been wrong a lot of times. Tyler, thoughts?
I'm gonna completely punt on any conversation about Pitney Bowes, because I don't have a knowledge base of the company to comment on it and give anything insightful at all. But on that idea of when it comes to contrarian thinking, it's even when it comes to things like negative too. I know that a lot of people don't put credence into like short reports and things like that, but they do exist for a reason. Like you don't just people aren't writing short reports about Apple, right? Or they're not writing reports about really quality companies. Typically, like there is at least something to however the market's pricing something, however somebody's saying something negative about a company. Maybe the intentions of short reports are like a little bit more nefarious, looking for short-term pops on stocks, but like there's probably much more knowledge out there that you're more likely missing than the market itself. I think at any given moment when we make the decisions on investments, what would you say like the percentage of the actual knowledge of like knowing everything in the company do you think you have? I think probably at best it's like in the 70 to 80% range. Like I'd never have like 100% knowledge of a company. And so there are going to be gaps in what you're looking, and you kind of do have to assume like I'm missing something here. What am I missing? And at least for me, that's the way I keep digging, because I'm like, well, what am I missing? What am I missing? What am I missing? I have to be missing something here. And so that's what I end up doing when these companies that stand out for some reason, like maybe it's trading for single digit earnings, or maybe it's the stock is down like 40% in 6 months, because of like a great example like we saw with like Celsius recently. Like they had a pull forward on inventory from Pepsi, like where Pepsi like, maybe we ordered a little too much too early, and then they kind of had to adjust back down. Things like that. We saw Celsius stock drop precipitously as a result. And so when you see these major events, it's always like an assumption, be like, there's a few things that you're missing, and you just got to keep digging, because you'll either find why the market is doing it this way and not just being like, oh, the market's illogical, I know what I'm doing. It's way more nuanced. Be like, this is what is scaring the market, and here's ABC why it might not be that issue. And if you can kind of game out from discovering precisely what the market is not seeing, it you're more likely to you know be a success with these contrarian thinking sort of ideas.
Tyler, I want to pick your brain for a moment, but I think this will be of benefit to members. So you spend a lot of time in like the oil and gas industry, and
Hmm.
you understand REITs and real estate investments very well. When you get to that point where you think you know as much as other investors do, reasonably informed investors or professional investors, and you have that sense I'm at 70%, which I feel I'm right there with you. Like I feel sometimes when I've done some good research, I might be at 70% of what I can know about a company. Do you try to get a few more percentage points of edge through like filings and documents? Or are there other ways that you try to figure out what it is you want to know about a company? And I say this because we're in an age where information is so relatively available. The playing field is spread very equally. We all have access to whatever the latest AI tools are. Um, so if it feels like that part of the game hasn't changed at all. There was at some point when the internet became a thing where suddenly everyone had a lot more instant access to information. The playing field leveled, and I think it's the same way today. How do you get a few more points of edge in the places where you spend a lot of time?
um, as far as where more edge, I think that's where it starts to get really challenging because, like, I don't know, I there's an engineering problem. So I was did civil and environmental engineering growing as my at university, and there was kind of like this idea of like you can get to 80% with 5% of the effort. It's like specifically talking about like water treatment,
Yeah.
right? Like if I'm treating a wastewater to go from, it's coming from the sewer line and I have to dump it into the river, 80% of like my cleaning is going to be done with like screens and just letting it sit in a tank and it settles out. It's really cheap. It's 5% of the cost of the entire facility. Once you start trying to get to, the more you try to get from like 80% clean to 90% clean, all of a sudden that's 50% of your total facility. Once you get to 90 to 95, you're looking at 90% of your facility. And then that last 1 or 2% is impossible. Like you could spend all the money in the world and you're never going to have 100% clean water when it comes out. Like there's going to be something that gets through. As much as we try, and so it's in that regard too, where it's like it's a kind of a conservation of resources. Like you get to 80% with relatively not too much effort. Read a 10K, read a proxy, probably read like 10, 15 years worth of financials. You can get most of it there. Maybe a couple investor presentations to see where management wants to go. Although, that tends to have a little bit of fluff, making it look nicer than it might actually be. eh, Trying to gain that extra edge, like maybe some industry trade papers or something like that, so you can kind of assess the competitive landscape a little bit. I'm thinking like in oil and gas industry, you have like the services industries where it's like, are are like the assets in the service industry fully utilized, or is there a lot of spare capacity? Because if they're fully utilized, then all of a sudden profit margins at exploration production companies are likely to decline because service costs are going to start going up. And so finding some trade papers, finding a little bit of like industry news on top of kind of the individual company, I would say that's like as that would be like the few extra steps that I'd be willing to go that might get me into that 80 to 90% using my wastewater treatment example. But beyond that, it starts to become such a, mental capacity trying to get to that next thing that I don't even know if it's worth it, especially when you have this universe of companies to invest in, right? Like I remember there's this quote from Warren Buffett in the 99 shareholder meeting where basically he was, when he's looking at company, he's like, you start with the A's and you just kind of go and like, look what attracts you. And he's like, when we did it in the 1950s like that, there was a lot more things that popped off the page, like immediately. And so I find like if you are just like grinding away at like trying to find that little extra advantage, you're probably actually just better moving on to looking something else, because probably there's a better chance that you're going to find something that pops off the page by just turning over more stones rather than trying to put, I don't know, a month's worth of deep research into one company.
Yeah, that's very insightful. I can still remember when I was a kid, the Value Line Investment Survey, which was a paper publication, and it used to come that your local library would get the insert in the binder. It would update it once a month, and this was the same tool that Wall Street houses were using to also screen for stocks. So we're going back to when I was a kid. I hate to say this, like 70s and 80s, but things could pop out then. I mean, not to me. Okay, I just thought this was sort of cool. I didn't know what it was, 7 or 8 years old. But to a professional, things would pop out, and you had an edge because how many people actually read that publication? And for Buffett, he seized on so many opportunities early, and as did Benjamin Graham and his Buffett's teachers before him, just because of that lack of information dissemination. And I think I'll take something that you said, which is sort of so akin to the Pareto principle. Like you got so much yield with a relatively smaller amount of inputs. You got so much yield.
Yeah, I just basically described the Pareto principle.
Well, no, it's something more, a little bit more of a sophisticated version of it, but akin to it. That's why I said akin.
Yeah.
But yeah, I mean, I would say for me, I own many stocks, probably 100 stocks. And then I tend to expend the time and effort where I think it's going to be valuable for me, simply because I've either purposefully invested more in a company or woken up over time to find out this company is really rising in my portfolio. It behooves me to now see if I can get a little bit of an edge. And I think that's probably time better spent than trying to be perfect on one idea. And I've done that in my career, earlier in my career, which again, this goes back to why we should hold 25 stocks or more. Sometimes you will think you know a stock or a small group of stocks perfectly and can be Warren Buffett with a concentrated portfolio. That's really difficult to do. It's romantic as it's presented, but in practice, excruciating. Tyler, we have a question for you on some industrial.
He does. There's actually two of them that are kind of the same question, so I think I'm going to hit them both at the same time, because Vihan asked 31 minutes ago about Torreno versus Prologis, but then just asked, he tossed in a couple other REITs in there as well, Rexford Industrial Realty and East Grove Properties. So I'm just going to combine those two questions and we'll hit it as this one. Asking basically gold, silver, bronze in the industrial real estate sector, of the ones that he picked. And I guess the easy answer is that I own three of them. I own Torreno, I own Prologis, and I own Rexford. So I'm definitely bigger fans of those ones than East Group Properties. I don't have a whole lot against East Group Properties in any way. I think they have a decent strategy. They're a little bit more build and development centered. So that's a little bit more requiring of capital than some of these other ones. Prologis, of the three of them, I mean, they're the biggest and they've been one of the best operators. There's always that creepy feeling when you get that big, though, is like, well, the law in real estate, the law of large numbers eventually starts to catch up to you. You can only own so much real estate, and it's not like you're able to, because you own more of that property, you can therefore charge more and, get higher growth rates because you just own more property. Like tenants are pretty fungible. They'll just go somebody else that can get you a better market rate when it's time to come to a lease. You more or less have to go with prevailing market rates. Prologis has found some interesting ways to get around the law of large numbers. They started doing like third-party management for other companies, as well as being like a debt financier, because it really helps when you have a credit rating that is akin to most governments, and they can get denominated debt in like the 2 to 3% range in today's environment. There's not a lot of companies that can do that, and so they've been able to leverage that a little bit as an advantage for them. I would say I would prefer Torrento and Rexer, to Rexford Industrial, to Prologis of those three. And I don't know if I could decide between one of the or the other. These two are both excellent niche operators in these industry that have focused on those shrinking supply markets. So higher growth rates, higher per share value growth, and management that seems very intent on growing per share value. Both of these companies have like 10 to 15% dividend growth rate over the past 15 years, and a lot of the similar operating models. So of those three, I would go those two over Prologis, but I it's not like a gigantic lead or anything like that. They all kind of hover around depending on valuation at any given moment.
So I'm going to tackle a question on long-term options calls from Dominic Monda. Do you have any growth stocks you're watching for long-term options calls where break-even is 20 to 40%? Break-evens that expire in 2026 or 2027. Yeah, I'll admit, Dominic, to being enamored by long-term options leaps. I think it can be a somewhat fun way to utilize leverage. I myself don't trade on margin, and I advise most investors to try to avoid borrowing money to buy stocks. When you buy a long-term equity anticipation, I forget what the acronym actually is. Long expiry. I'll have to Google it up. It's been many years, but
You keep talking and I'll do it for you.
yeah. Okay. Thanks. Yeah. So I think this is maybe for some of us a way to more safely use some leverage. And here's what I'll say about growth stocks in this game. The issue can be that companies that are self-identified as growth stocks, meaning thereby that you're watching that stock price go up, are usually of the more volatile sort because the opportunity is great. So the cash flows are volatile. The expectation of future cash flows is all over the map. Some people think X growth stock is really going to outperform its peer group. Some think it's going to hit a roadblock. And so the stock is volatile as an expression of that uncertainty, which could be positive. Then what happens is this gets reflected in the pricing of the option from the Black-Scholes model. And then we see the premium start to rise in the price of the option via implied volatility. So if the implied future volatility of the underlying asset grows, that's actually making that option more expensive. It's great for people who may want to sell an option against that underlying asset, but it's not so good for you and me who would love to buy a great growth stock today via a proxy like a leap and break even or make money in 2026 or 2027. So I will just tell you my personal strategy for this, where I've exercised it before, is to identify some companies that are growthy, but not the growthiest of growth stocks. I compare the IV components, easy to get. If you can look on Yahoo Finance and it'll break it down in the options section, or most brokerages will do, compare that implied volatility to other companies in that sector or industry. And if it's more reasonable, so the stock itself is not as volatile, so that rich premium isn't there in the option, I'll put that on my list. And then I'll wait for like a sinking tide to drag all ships down. I'll wait for some market mayhem to pull even really good companies that have a great future ahead of them to just fall with the rest of the market. That tends to be an ideal time to buy not the growthiest, but growthy leap options. So this is just my personal strategy. You can sort of implement what you're saying. I would just advise in general, be careful of that maybe unsuspecting risk where, and you seem from your question to understand how these works, where the asset is rising, but because of the time component in the leap and because of the relatively higher implied volatility, you're not seeing that option price move the way you wanted it to. And then even time can work against you in a leap. But a fun question to contemplate when the market seems like maybe we'll have a little bit less of a growth year versus the last couple of years.
So the the research while you were talking. It's long-term equity anticipation securities, which
Anticipation securities. Yeah, I almost had
that
it. But
that's kind of a
P at the end
it's
got
kind
me.
of a bad right. There's a
Right,
bad
because
acronym. There's
I
no
was
P.
I was tripping in real time. Not that I didn't really know it, but I was like, wait a minute. What does
Where's the P?
P stand for? It should be an
Yeah.
S here. Okay, thank you, Tyler.
Yeah. I'm gonna have to punt on this one. I am the most meat and potatoes investor. I don't have a single options thing in my portfolio. I people have tried to get me to flirt with, writing, what is it, selling puts just for income, but other than that, no. And I every single time I look at it, and I look at it. I don't want to do this. This is too complex.
So I'm going to call Tyler out on this. This is his humble way of saying I'm a successful investor. I'm a meat and potatoes investor. I don't go for the exotic stuff.
I just get so scared when I look at options. I'm like,
Yeah.
I feel like I'm like, I don't know. It feels like I'm, picking up a penny and could get hit with a steamroller at the same time.
It's risky. Options are risky because you can control most of the elements when you invest, but not the time component. If you then translate that into options, it's really working against you if you get the time component wrong. They expire. So,
yeah. This was a question that popped out to me before I got on, and I saw it and I was like, this would be a great conversation topic to have with Asid. So this was 22 hours ago. So this was yesterday, and hopefully the person who asked, Neil Vita asked, and I hope we can get the answer to his question to him. But the question is, if hypothetically you knew someone who works for a public company, is it safer to not be invested in that company? It's funny because I've read two of the books on my shelf over here are Peter Lynch's One Up on Wall Street and Philip Fisher's Common Stocks, Common Profits. And those two people would profess about wanting to talk to people in a publicly traded company and wanting to get that information because in Philip Fisher's words, it's scuttlebutt. It's, that little bit of extra inside edge of knowing. Now, there's a difference between inside edge and illegal inside edge. I should be very, very clear here because illegal inside edge is basically when you have information that isn't publicly disclosed to the rest of the investors. Like, say, for example, your company, this hypothetical friend who works for this public company is aware that the company is exploring being acquired and this has not been announced to the market. That is like non-public information. That's you do not want to get involved in it. But like, if you know people who are, purchasing managers and things like that, or people who work in the business and can give you thoughtful insights into the business, that it's just like why they're good at something or why they're, maybe a little less good about something. That's not trading on insider information. Most of that stuff is pretty publicly disclosed in the 10Ks, maybe not given to that precise color, but it kind of goes into the, the Peter Lynch, Philip Fisher was like, buy what you know, and knowing people and talking to people in businesses can be an advantage. You just have to know, you have to have the discretion of knowing when something is, maybe something a little privileged that you should stay away from versus just being like, yeah, we're doing great. And those are two very different things.
So Tyler, I really like your answer. I was going to say something slightly different, but along the same bent that, depends on how closely placed that person is. Is it an organization that has 50,000 employees and your friend is, the most recent hired and not very high up the ladder, then I don't think that should preclude you from investing. And I was going to give the same caveats that something that sounds material and insider-ish, you should just avoid. But I like the sort of test you laid back because I came up with an example in my mind. You're talking to a friend, maybe over beer, a good friend, it's the weekend, and like, how are things going at company X? He's like, yeah, I guess we're doing all right, but I don't seem to be paying our suppliers very fast. I'm having to field a lot of calls. That's not actually insider information, but a litmus test you could pull is what Tyler was describing. Like, could you go to the financials next quarter and sort of derive the same? Sure. You see the payables balance rising and the working capital looks like it's getting a little tighter. Then what you've really just had from someone who's very low on the corporate ladder is some scuttlebutt, some color. That's not illegal, actually. But I think the line becomes fine, and it's almost that common sense. It's almost easy to understand the example you gave, like an upcoming acquisition or a
Yeah.
disposition or upcoming
About to
layoff.
sign a
Yeah.
huge contract for a big deal or something like that.
Yeah, something that feels significant. Just be careful, and the best policy is to. So okay, so I'm taking this from, as I was thinking about this, I'm an auditor by training, actually, and one of the things they teach us when you're getting your CPA license is to avoid impropriety or the appearance of impropriety. So sometimes you can be totally in the right. You're not doing anything wrong, but it just is a bad look, bad optics. And that also can be problematic if you have a friend who might have something material and you're you've done your own homework, you've never really talked to that person about the company, but I don't know, they're the CTO or something. And the company has been doing really well, so other folks are buying it. Sometimes it's just almost more trouble than it's worth. So what we're both saying at the end of the day is to use your judgment. Be wary of anything that's material or significant or important. Be aware of where people are placed in an organization. And there are many other fish in the ocean. If at all you feel like it's not worth your time to worry about it. So, and stay on the right side of the law. I think that I heard Tyler
I
basically
mean,
say
obviously,
that as well. Yeah,
always stay on
obviously,
the right
right?
side of the law.
That's table stakes in life,
Yeah.
people. In life, it's table stakes. And some of you may think I'm saying this facetiously. Woody Allen, who okay, back in the day was well respected. He's not so much anymore, but he had a few things that were valuable. He said 80% of life is just showing up. So table stakes should be abiding by the law. Table stakes, or 80% of life, should be just going in and doing your job. As an investor, table stakes should just be doing the minimum amount of research. Never buy a company just because you saw the ticker flash up that we recommended it in a service. That's not doing your homework. You need to check behind the Motley Fool. Read the recommendation. I always tell new members this. Don't buy it because you saw that it was recommended. Read the recommendation, see what you think about it, do the minimum amount of homework. In life, this helps so much, Tyler. Just getting that minimum bit done. The rest, again, we're getting back to the Pareto principle. The rest is there's always 20% left in every proposition. But
Sir, you also, you got a nice thank you from Merton answering the question about China's growth and new economic models. So little shout out to Osset for
great.
eloquently answering a question that I probably butchered way more. I'm going to hit one from yesterday. It was about a stock I know, and I think you might be able to go in a bunch of different directions on their customers, a little bit more than maybe themselves. But the company MCOR. This is a electrical and mechanical contractor, second largest in the U.S., and it has tangentially become like the third derivative AI trade, I think, if you will, because obviously if we're building data centers, we're going to need electrical contractors. The stock itself, the question has been Ed asks, it has been slow and going down. Any problems? Do you think this is a buy? I don't think. If I just checked recently, I don't think that they've reported fourth quarter earnings yet. So can't really put any numbers behind some of the recent changes in its stock price or anything like that. I think a little bit of the DeepSeek hangover might be involved with some of the stock price, but it could be anything when it comes to just random stock price movements without any sufficient news. The one thing that of note that has happened in the past couple of weeks is they made an acquisition. It was a acquisition of, I think it's called Miller Electric, which is kind of the calling card of MCOR, and this is how they've been for pretty much their entire existence. They're one of the industry consolidators, if you will. A bunch of small bolt-on acquisitions of smaller players. You gain regional efficiencies and things like that. I, I I don't see like the acquisition of Miller, excuse me, as a like detriment. It's not like a big one. I think it was like $800 million. So for a company of MCOR's size, that is a very digestible sort of deal. It's not like one of those like corporate culture shaking ones where you're merging like companies of equals. So I don't think I this is going to be, because it now has this association with AI. I think it's going to be a much more volatile stock. A lot of people who've been betting on that AI, that component of AI growth, and all, the whipsaws of like, well, if DeepSeek is a thing, then maybe we don't need as much power and data and processing and all that other stuff. Maybe, I don't know. I've been quite a fan of this business. I think it has a very long-tailed advantages in the coming years, not just from AI, but basically the electrification of everything, electric vehicles, building a growth, reshoring of manufacturing, like semiconductor plants and things like that. I think there's a lot more levers to pull than just AI, and I can't say that I'm too concerned about any of the recent price action.
That's a great answer. And there's a specialist. I mean, they aren't sort of a garden variety construction company. So outside the data center, that last thing you mentioned resonates with me, because buildings themselves are going to become smarter and more complex. So companies that already specialize in this, likely have an edge. I'm going to tackle in sort of bullet fashion just a couple of questions. So Jags had asked, and I missed this 50 minutes ago, I said, apart from stock picks, are there suggestions to move funds around in anticipation, like investing in gold, other sectors, suggestions for self-read? So yeah, Jags, I think everyone should have a diversified portfolio of investments. And sometimes it's helpful to think of your stock portfolio as just that. I mean, it's just one part of your whole. So just doing a personal finance clean sheet exercise is one of the best things I can suggest. Maybe draw some circles and understand where all your assets are invested. The house is problematic because a house in some ways is an investment, but in the other ways it's your domicile, it's where you live. So there are many considerations there. But I think there are also proxies in the market as well for other investments. So if one wants to invest in inflation hedges, there are ETFs for that follow gold or other assets. Of course, there are digital currencies as well. I personally try to stick to the bigger, more established ones, so Ether, Bitcoin. And then just looking at cash, always thinking about cash. I take your anticipation to mean what I was referring to, that I'm not so sure we'll have another market year of 25 or 26% gains, but I'm in it for the long term. So I don't change my strategy that much. I try to invest in companies that are going to generate lots of value, lots of returns over an extended period of time. So while you hear me say that, it's not that I'm shifting things around because I have to make the money every year equal to the last year. I understand some years are actually going to be down years, and that may provide some opportunities for me if I have cash on the sidelines, which I personally try to do. So there's that. And then just really quickly on PayPal, there's a question on the merits of PayPal. What I wanted to point out here is that they're sort of still in the early stages of Alex Chris changing that business. This is a business that is not just like a platform business that is very rooted in global commerce, but it's a business that's already at scale and has many advantages for its bottom line by getting a little bit bigger, but more efficient in take rate, in operating margin. So if you listen to the calls just for over the last year, you'll sort of get what the strategy is. But I think the strategy is sound. It's, move to higher value customers, help merchants out, increase conversions at checkout, which they're very, very good at, and scale that free cash flow, which is just monstrous. And that's one of the reasons why I personally think PayPal is a fine investment for those who want to get a toe in the water of the payments space. I think it's still in the relatively early stages of a turnaround. It's going to be volatile. This last earnings report showed that it's not just a clean path to the glory that Chris had projected, but they're making strides in that direction. So I still think it's a great model. And I think we got a few seconds. If there's one last question you want, or you can take us right out.
We can do that. I think this is a great way for us to go out, because my answer will be really short, and I'm sure yours is a little bit more nuanced because of, and it actually has to do with the age of our children more than anything else. Because Vihan asked if building UTMA or UDMA accounts for children, how would you approach? It would be nice to hear what you did, Osset, either that or a 529 account and lessons for youngers. Obviously these are very personal questions because like everyone has different situations, but like for me, we live overseas, and so we went with UTMAs for our children because we thought, maybe what if our kids get the living international bug that we do and want to go to school, in Europe or somewhere else, rather than the United States. And we didn't want to necessarily be bound by the ideas of, 529 limitations. And also on the allocation stuff, like right now they're 2 and 4. They don't really care about investing yet. And so it's just kind of like going into ETFs, and I don't let my own hubris get in the way of my children's money.
Yeah, such a great answer. And I'll be super succinct here. It's funny, for us, we went the 529 route, and I've got 3 kids who love to travel the world. One just got back from a study abroad last year. One is outside the US. The third wants to go every summer. But what really helped was just getting started. And I know from so many comments Vihan has made that he is someone who is very thoughtful about investing. So just being able to invest regularly is the key. And I went with ETFs too, Tyler. I didn't overthink that. Now, I took different risks in my other taxable accounts for myself, but sounds like, we can't give personalized advice, but in general, this is the type of strategy all of us benefit from: getting started early, being regular, even if it's small amounts, and not over worrying what type of account you set up. Again, I set up something that probably would have been maybe a little better going the route Tyler's taking, but you don't know what the future holds for you. Doing it is more important, and being consistent with it through times that are thick and thin, except when they get too thin. And some of us hit this in life. I hit it in life once, where you just can't contribute anything this month. That's okay. But being as consistent as you can is sort of the greatest gift you're going to be able to give your kids as they grow up.
So I think that's a nice way for us to end our hour. It's 3 minutes past the hour, and I think that we'll be bringing on. Is it Andy Cross is coming next? I see him in the green in there he is. Oh, Andy and Tim. I didn't see Tim too. So looks like we're gonna have a nice full house, and probably a little bit more tech. Certainly a lot more than I'd ever be talking about.
That might happen. That might happen. All right.
It might happen.
Maybe.
Yeah.
Thanks, guys.
Tyler, Osset,
Thanks, guys.
thank you. Appreciate it. Welcome to another hour of Fool24. Great day, Andy. Great day. Phenomenal day so far.
You want to elaborate a little bit on that, Tim, for about 30 seconds?
Palace 2, Fulham 0 at Craven Cottage. That is nine consecutive unbeaten.
There you go.
On the road, best away defense in the league.
There you go.
Yeah, fun too. So I hosted a watch along early this morning, AC. So I had 2 hours early, and I got 2 back-to-back hours. So yeah, it's a video day for me.
That's awesome.
I'm all right with that.
Do you have that at your house? Like
no.
Okay.
In fact, the same thing we use for Fool24 StreamYard is the same one that the fan group uses for. So I mean, I was here. Yes, I should say that. Yes, it was here.
All right,
and we're just like hosting it. But anyway, let's talk about things that are.
Well, IJ, just very quickly. We got Man City tomorrow. Liverpool, Man City,
Big
and
time.
Arsenal lost today. So we have
better take advantage of that.
Take advantage of it. Yep.
Better take advantage of
We'll
it.
see.
All right, here we go. Let's talk about. Do you mind if we start?
No,
with
you.
Just my. All right,
go.
Let's start with my screen shares on Toast. I have some screen shares on Toast. So Bart, when you are ready, kick it up. There it is. All right, let's talk about some of the key. I want you to pay attention to the box in the middle, rule of 40 down to magic margin. Magic margin is the core profitability margin. That is adjusted EBITDA divided by the sum of fintech gross profit and subscription gross profit expressed as a percentage. And long-term, management has said they believe they can consistently get that core profitability margin up to between 30 and 35%. It was up massively over Q4 of 2023. You can see that 29.37% versus 10.7. So it does look like they are moving north here and getting, they're just becoming more and more efficient. Operating margin profitable for 3 consecutive quarters, GAAP profitable for the first quarter. That was true this past quarter.
Great.
The rule of 40 score is rising upwards. Everything is moving in the right direction here. And I'll also just point you out this annual recurring run rate, which is essentially a sort of an estimate of all business that we can expect on the Toast platform. That was up greater than revenue, up 33%. And it's roughly in line with, they have been growing at roughly this same rate or better for a while now. So they aren't really slowing down. And that is a message that I really like. Last thing, 7,000 locations during the quarter. That is very good. That is very consistent. And this is the per location data. So I'm highlighting here again, adjusted EBITDA per location, free cash flow per location. You can see here, up a massive amount. The adjusted EBITDA, this is why that core profitability margin is soaring. When you are roughly 3xing your adjusted EBITDA per location year over year, you're going to see some increases in your core profitability margin, and your free cash flow per location up not quite 30%, about 25%, but $1 million per location, up from $1,000. Not a million, $764.15. That is quite good. And then I want to highlight this here. So fools know that I tend to track the cash flow return on investment, and it's really good for Toast. It has been good for the past 2 years. It more than doubled from 2023 to 2024. So you can see here, I just wanted to show this. So look at the total equity, that total equity line. You can see Toast did not skimp. It did not skimp on issuing equity to employees. They issued plenty, but that is captured in that total equity line. And the cash that they generated available for investment, including for deferring things like traditional stock-based compensation expense, they still generated a big return there. So the CFROI is jumping. And then we use this internal AlphaSense tool, and AlphaSense shows that the return on invested capital is additionally up over 22. And that is way above, Andy, way above the cost of capital. I would say, even though Toast did not, nobody gave them I'm going to stop the screen share here. Nobody really gave them any kind of applause for this quarter because the outlook was and the EPS number was only 6 cents a share, and the consensus was 17 cents. So there were there's more diluted shares outstanding. But still, the health of the underlying business, I think, is undeniable here. So it's a bit of a sell-off. For me, your mileage may vary. It's still my highest conviction stock. I still would like to buy more. So you can expect that I'm talking about it now, and then I'm going to stop talking about it so that I can buy more. But I wanted to talk after the earnings report here. But thoughts on the Toast results, Andy?
Toast, symbol TOST, provides restaurants, as you mentioned, thousands and thousands, adds 7,000 to 8,000, 9,000 restaurant locations a quarter. And they offer point of sale solutions, cloud-based solutions, all different kinds of solutions for both restaurants. And they really specialize in helping, regional or locate firms that might have a couple different locations in an area with their with their payment technology and their payment systems. So, Tim, as you mentioned, I think you laid out what you want to see, pretty much kind of what you want to see from companies like this that are adding locations, they're growing, yes, they are using equity, or yes, they are using debt effectively. They're earning more returns. When you look at the Moneyball scores, the round to the return on invested, the return on net tangible assets is negative for Toast. Well, that's because of some of the costs that they're adding in there into their stock-based compensation. And so that's an expense that's, counted onto the net income line, as Tim, as you were talking about, and if you adjust accordingly for this. But it's effective use of capital, and the product that they're offering and the solution they're offering to their, both for the front of the house and the back of the house, has real synergies. It's a winning combination. I encourage, if anyone's out eating, they're now more and more, you see them online, but eating, see if there's Toast. I said over the holiday, I saw more and more Toast locations and more Toast devices out there. I like it too. I've recommended it at different spots, and the pullback doesn't really concern me at all. I really love to see as they continue to push up that arc, and they're still adding thousands of locations, and they're not even saturated. They still have loads of locations to add just around the U.S.
There is. So let me give some other stats here. This came from inside of AlphaSense. We did. AlphaSense has its own internal AI to pull from financial statements, the earnings call transcript. So here are some things that AlphaSense pulled out for us on guidance and future outlook. For 2025, Toast is expecting to add a comparable number of net locations. So that was 28,000. It was up 26% year over year. That's a good sign. They are adding locations not at the same rate as revenue growing faster than location growth, which means they are adding more business per location, which is great. You want to see good location growth, but it's even better if existing locations are growing and adding revenue faster than you're adding locations. So you're not location dependent per se. Mm-hmm. So that was great. 23 to 25% growth in recurring gross profit streams. Adjusted EBITDA guidance for between 510 and 530 million. That's a 30% margin. So again, on track with that core profitability margin. This is the one that I think is underrated. So I'm going to say this one slowly because this is to your point. Toast has barely scratched the surface internationally, Andy.
Yeah.
In fact, last quarter, I think it was either 1,000 or 2,000. I think it was 1,000 locations internationally. So Toast is expecting to surpass 10,000. So roughly 5x to 10x the number of locations in international. So this is new segments. This is enterprise. This is like bottle shops. This is everything. This is the international locations plus the new retailers, grocery stores, liquor stores, international locations. So overall, between those two segments, it's not 5x to 10x. That was 3,000 the last quarter. So they're expecting to 3x it, not 5 to 10x it, 3x it. But that's still massive.
Oh yeah, for sure. Yeah, and their Toast Capital business is doing well. Their underwriting processes are improving on that, Tim. And so, this is one of those ones where it's a competitive space. There's no doubt about it. There's loads, and we all know the competitors out there, including Square and others. It's just, but the way that Toast is building out their system, adding the locations, looking internationally, growing the profitability, continuing to grow in that 20 to 25% range.
Yep.
Gross profits growing maybe even a little bit faster than that. Like, it's just, you can, I just like what I'm seeing coming from Toast, and relatively small growth kind of company. You got to expect the volatility as an investor. And we saw some of that on Thursday or Friday.
Right.
So,
okay. So let me just.
Yeah. Like Tim Foolis just says, Toast PE is 1,256. And that's just, we had answered a question on the last hour, Foolis. Maybe you remember this when I was on with Toby talking about which metrics do you use for which companies? PE, price to free cash flow,
Right.
price to book value, all those things. And the PE ratio for a company like Toast, if you're using like GAAP accounting based earnings, really is really missing the forest for the trees, I guess I'll say.
Yeah. Let me just quickly.
But I understand why fools would say it, so I empathize with that. But just give me some context around the kind of company and where they are in their life cycle and how companies like this generate, Tim, as you were saying, that from the return on the cash flow that they've invested, how they can continue to generate cash to fund their operations, minimal amount of use of debt. Yes, they do issue some shares for their employee base, but for small growth companies, that actually is not bad. There are indications that if you are growing your asset base and you're getting more efficient with that asset base for small growth companies, you should be doing that.
Yeah,
It has to be reasonable, and you have to have a clear return on that, which I think Toast is getting.
Yeah, let's share my screen one more time. I want to show the updated model. So Bart, yeah, here we go. So this is the updated model. This is annualized return. So here's how this model works. This is I want you to pay attention to the highlighted part. You see that 16% FCF up there? What that means is this is a terminal free cash flow margin of 16%. Not where they are today, but where I think they could get to, which is, remember they said that core profitability margin could be anywhere between 30 to 35%. So I said, what happens if you take half of that and you correlate half of core profitability as free cash flow, which is about where they are right now. So 16% is your terminal free cash flow margin. At that point, you have a current enterprise value of about $21.6 billion in enterprise value. And so your core inputs are, this is a 10-year valuation, 55,000 average revenue per location. That would be up from 40,000 today. Over a 10-year period, that's roughly 4.5% annualized, a little bit better than inflation, but not outrageous. 350,000 locations from where they are today. That's about 134,000 locations. That's a bit more aggressive, but I don't think unreasonable, particularly given how aggressive they're being in getting into new locations. I think that's doable. That gets you to a terminal revenue number of $19.25 billion, and at a 16% free cash flow margin, you come out about $3.1 billion in terminal free cash flow at the end of the period. And if you apply a market average free cash flow yield on that stock at that point, you end up with $93.3 billion in enterprise value. That's a 15.7% annualized return before any dilution. So don't think about that as an absolute number. But I think you should never think of those as like an absolute number or a precise forecast. It's just directionally.
Yeah.
Is this fairly valued? I don't think so. I think there's still a lot of room for it to grow.
And Tim, that's such a great point. And thank you for, by the way, carrying it all the way out, all the numbers and the decimal points. I love that in your spreadsheet. You're not rounding up or anything, all the way. I love that. I think many, especially newer investors, think, and many who are watching us on YouTube here are thinking about investing as a game of precision, and it's not. It's really a game of direction, and understanding that when you use, Tom used to call them thumbnail valuation techniques. You use numbers like you were using. You look at the locations, and we're talking basically just restaurants. There is still part of Toast's ecosystem that can be used for retail and other spots. I've already started to see it. So like there's other parts that they can play into, but let's just really focus on the restaurant business, because that's really their core. When you put that in the numbers and you look at that and you start using estimates, you say the valuation does not look unreasonable. Yes, they have to deliver. Of course they do. Companies are expected to deliver, or else we wouldn't invest in them. They have to deliver, but the market might be not giving them enough, or the stock price enough of a belief, or enough of credit of what they can accomplish based on what we are seeing and what we think they can see, knowing the experience we've had investing in other companies like this. And Toast looks like it's directionally reasonably, if not undervalued.
Yeah, that's that. So that's my argument
Yep.
on Toast. I just wanted to give that, from
Yeah.
time to time, I got to update my
And-
thesis with people. So there you go.
Well,
There's
and
my
Foolist
updated thesis.
and
Yeah.
Foolist, that's the reason why we don't just look at the PE metric for something, or really any of
Yes.
our companies. Now, so for some companies, it's like PayPal or something like that. It's a lot more understandable,
Yeah.
but for a
It's more
company like Toast,
constructive.
it's
Yeah.
not. Hey, young Tom Morris, which is a name I just love, reflecting on the great golfing family of Tom Morris. Thoughts on Cart, Tim, since I know that we both follow it. It's got a low PE, but it seems like it should be a growth company. What am I missing with this one?
I think it's just outliers. Don't
I think
you
so.
think,
I think so too.
leftovers from the IPO?
Yeah.
You,
This is
you would have
Maple
to-
Bear. This is Maple Bear, Instacart.
Yep.
CART is a symbol.
Yeah, you would want to normalize some of the cash flows, but I would say this is another one where I think for Instacart the real benefit is to be the strong number two in grocery pickup and delivery, and I think that this is another one where a paradigm shift really plays into the hands of the company, of the founders. I think grocery pickup in particular that is not going away. You
Yeah.
see it everywhere now. Every time I go into the grocery store, I see a big, thing of like all of these orders that are lined up for pickup or delivery, and there's a ton of them. And the orders are not necessarily massive either, Andy. So like volume of delivery is increasing. I think there's a lot of space for different players in this market. So I think there's room for a very productive and interesting stock advisor rec, DoorDash. I think they are in a different position, but I think they have some options here. Instacart's a little bit different, but I do think overall shelf space in the store matters a heck of a lot less than digital shelf space now. And what I mean by digital shelf space is in the app, regardless of what shopping app you're using, but in particular, let's take Instacart, for example. Instacart makes some decent money on advertising, and the advertising dollars are, hey, like you're filling up a basket, the Colgate coupon pops up on your Instacart app. That's shelf space, which the Instacart gets paid for. It's a very interesting data-driven business. I don't think it is at all overpriced just yet. There's a lot more that we could see in terms of moving to digital first grocery delivery and pickup.
I think so. And what I came to appreciate with Instacart, Tim, is the grocery deliver is pretty complex logistics. Matching up, delivering, picking out the order, partnering. We use Instacart all the time, picking out, partnering with the customer, seeing what's in stock, what's not, and what are the alternatives they may choose. All of those things, packaging it up. That is a very complex, and Instacart has come to master it and has a leading market share versus like DoorDash, which is really specialized in like more restaurant pickup. So could DoorDash do what Instacart does? Maybe to some degree, yes,
a little bit,
but they're operating in different spaces now. Yeah, and I think Instacart, the financial model, it's not the valuation, whether it's PE or other valuations. You just look at the marketplace, looks reasonable. And Tim, as you mentioned, they have the advertising business, which is it's not like it's unheard of, but I think that's going to be, along with DoorDash and other in-app companies, we're starting to see more and more of that is going to be a nice little additional high margin cash flow for Instacart. So I think Instacart looks attractive.
Yeah, it's been generating cash for a while, and they get the benefits from stock-based comp for that. But overall, I think they've done quite well in this area. We could take down the questions from. Let me make sure we have this. Yeah, we did take those down. Okay, great.
Yep.
Do we want to quickly? I've got two others that we can talk to, because these were companies that came up during during the week. They reported earnings during the week, and they didn't do great, Andy. They
Yeah.
were so I'm going to come back to this, but I want to show Endava. So hopefully you can see this. Can you see the Endava
Yep.
press release? I didn't have time to screenshot this. Both Endava and Globant had some pretty rough quarters. And I think this is part of the issue. It's just not recovering. They're just not recovering. Single digit revenue growth just isn't doing enough. This is not to say that these businesses have turned bad, but I do think, Andy, they leave open a question of when the world is doing nothing but trying to optimize for AI workflows and you don't have all of the AI business, it's much tougher to grow. And that's not to say that Endava doesn't have some. I'm sure that they do, but it just isn't the same. Now, taking a look at Globant, just focus on this for a second here, right here. So you can see 15% year-over-year growth for the full fiscal year. All right, just park on that for a second. Now come up here to the fourth quarter. Revenue up 10.6%. So growth materially decelerating during that fourth quarter. So why did Globant get destroyed? I mean, there's probably other reasons for that, Andy. Could be the outlook. Could be a number of other things.
It's definitely the outlook. There's no doubt about it. The outlook moved from 15% down to mid to high single digits on the revenue side.
And it continues.
Disney growth's going to get cut in half.
Yeah. So that's more than I knew because I didn't have a lot of time to dig into it. But what that does is in terms of the outlook, that continues the trend that you saw in this past quarter. So you have a material revenue deceleration, and then you forecast for another deceleration. That's not great. That's a bad look.
Well, Tim, I think what is even more interesting, as I started writing about this, and I just didn't get it finishing on Friday, is the reason why that is for Globant, and it's really tied to their professional services business. So they serve a bunch of different kinds of clients in different areas, including Disney as their largest client. The Disney growth, I want to say, Tim, was north of 20%, either last year or last quarter. Outstanding. In fact, it came in stronger than they expected last quarter. But for the coming year, I think they're down more in like the 10% growth range, maybe even lower for Disney. Disney's a very large customer of Globant. But what's interesting is they talked about this repeatedly. It's really on the professional services parts of their business. So they serve travel and entertainment and banking, financial. Endava is really big into banking and financial. And we're seeing this. We saw it from Manhattan Associates. Now it's definitions between professional services for one and the other is slightly different, but it is the fact, Tim, that as clients are integrating software, using more packages, and Globant is tied fully into AI. I mean, like they're definitely like generating revenue.
All of them are.
AI. Well, Accenture is too, right? So, and Accenture's bookings are incredible but it's just that going forward, if clients are finding, I just don't need the marginal dollar spend on some services because I have all these other tools now that I can get for $20 a month.
Right.
And that helps me enough to kind of do my job. And I think we're seeing this more and more. And ServiceNow talked a little bit as well too, Tim. And so that as I have said this week in the last 2 weeks, on the the marginal, if the marginal dollar is not really coming in, that's going to hurt not just the growth rate in the sales side, but really on the profit side. And you're just seeing clients stocks that were selling at, I'm just 30 to 40 times earnings, and Globant now sells for 21 or 22 times earnings of this year, right? So like you're just seeing them their multiples get cut in half.
Yeah. I mean, that's such a great point. I just want to highlight something you said there because this is something that's persistently true about tech. Very often, good enough wins. Good enough wins a lot. And so you just pointed out something that's super important. If you have a good enough alternative that gives you some financial benefit, a CFO and a CTO will choose that a lot of the time, unless the workflow that's being replaced is mission critical. So watch out for those situations where good enough tech steps into the breach and creates an alternative, and a CFO just starts to, they do the chin scratch like,
Right.
I wonder if we could get some benefit from this. So
Well,
yeah,
and
important
Tim,
point.
I just think you're seeing this more and more, a year of efficiency, all that kind of stuff. It's not, yes, there's a load of AI spend going into the foundations when it comes to chips, data centers, that those things. But the benefits downstream are still being weighed out. And it's just like, where can I get the most spend and save some money? And so clients, and that is Globant doesn't, by the way, Globant, unlike Accenture, really, Accenture isn't huge, but Globant has very little, federal kind of dollar spend. So all the Doge really is not yet impacting Globant because that's just not their core client. So it really is just some of their core customers. They still are seeing great success in some areas. They're just seeing some of the weakness come across those other areas. By the way, the expectations from the street, Tim, was not like they're going to continue to grow 25% a year. It's just that they weren't expecting 6 to 10% a year in revenue growth, or 6 to 9%, I should say. They were expecting more like maybe 10 to 11. And it's that marginal difference that sends your stock down 25%.
Yeah, the street doesn't like to be disappointed.
Yeah.
Disappoint them at your own risk.
Yeah.
All right. We said we're in the second half hour here. So let's go to the AMA portion of the show here. I think that's more of what was prepared for the most part. At least that's the stuff that I came prepared with.
Great.
Let's see. Do you have thoughts on this, AC? Because I do not. Vion is asking about Manhattan Associates. Value at current valuation. How does growth look in the next 3 to 5 years?
Here's the thing with Manhattan Associates, Tim, very quickly, is their cloud business is growing 20%. The rest of the business is really struggling. Professional services, which is a good chunk of their business, is stagnant. Will probably be a little bit down this year. And their professional services, like, hey, you get our software, we provide some hardware through third-party sellers, and we, as you go through your contract for the year, we're going to charge you professional services. More and more clients that they saw last quarter and going into this year are not signing up for those professional services. And that's very high margin revenue. And so that has really hit the forecast. And this was a stock that had done very well through this year with the expectations that will continue, that companies are going to rely, whether they're using AI or not, rely on Manhattan Associates' services. That is not the case. So their revenue is going to be stagnant and their earnings are actually going to be down because, again, the profitability for those two differences. I still think Manhattan Associates will be a larger company going forward based on where I think their earnings and cash flows can go, Tim. But it's probably going to take some time for investors to get. I've seen this before with Manhattan Associates over the years. I've been following it kind of since 2012, more or less, on and off. Tom had re-recommended it recently. So I think Manhattan Associates is kind of going to be in that, sand kind of up to their kind of ankles in a little bit of swampland as investors, and their business kind of works through this, and their cloud business at the end of through this year into next year, the cloud business is going to be larger than the professional services business, but that's going to take some time to work its way through. Okay, fair enough. Let me answer this one on Align Technology. It's from Sasha B 15 minutes ago. It's a rule breaker. Had a high valuation for years, but has slowly come down. 0% stock return over the last 7.5 years. Is that, man. Is it finally time to buy? This is an interesting one. I have not taken a close look at Align recently. I'm just looking at it, let me take a look at it now here. I would say, go ahead. Tim, it's just, I think Align is one of these businesses that now is their unit sales. I think Align still has, there was the upstart, what was that? Smile Direct Club, which kind of fizzled. That fizzled, right? Yep. But it's just that,
And that was the major threat to them, right?
yeah, and just unit sales are not growing 10%. They're growing mid-single digits right now. And so the growth story for Align is just, it's not accelerating
Yeah.
off of its base anymore like it used to be. And now it's just kind of in that single digits kind of story. And that just, I mean, that can make, I think, a decent investment from here because the price is so much more reasonable. But I think it's just going to be, kind of marginally okay.
Okay. I mean,
Is my hot take.
Well, you might not be wrong. I'm looking at this right now, Sasha, and the Capital IQ does not have all of the data in yet. But what they show is cash from operations at 738.2 million. They've classically had a decent amount of CapEx because they are a business that requires, they make a product and they have to do the work to make a better product over time. These, Invisalign braces. So you would expect that the CapEx would continue to be at least decent, about 200 million. But that cash from operations is down year over year from 2023 to 2024. And so I don't love seeing that. So for me, it just feels like it's okay. It's often okay to be patient with these types of businesses. And I think Align is one of them. Ed has a related question around this. And I mean,
I think
I think it's a fair question.
It is
Ed,
a fair question.
But I'm going to give you a hot take, Ed, here, because I think what you are expressing is your temperament as an investor is to move on quickly. And I have no problem with that. If that's what works for you, then move on quickly. Do what you need to do in order to stay overall a net investor in the market for a really long term. But what Ed is saying is, why can't the Fool move on but keep defending stocks they have recommended, such as Globant, Enphase, SolarEdge, even if they move up a bit? This is a dog with fleas. That's not always true, though, Ed. I mean, in these cases, they might be. I'm not so sure that's true of Globant. SolarEdge, I have some serious doubts about. Enphase, I think, and Enphase needs some macro help. I'm not so sure that I wouldn't agree that Globant is a dog with fleas. I think the moment for Globant is a little tough, but that's my opinion. But I would say, Ed, and this is why we talk so much on the Mindset Show about this. You have got to, you don't have to. I mean, this is not personalized advice. You should take my view with a big grain of salt. But my opinion is that investing in a way that keeps me in the market for the very long term is what I need to do. So sometimes I will make moves that are non-intuitive. Let me give you an example. This is why I say, if moving on quickly for you works best, I have no problem with that, because what I do in order for me to stay engaged in the market, Andy knows this, it was a crazy thing that we had this years ago when I first told our team, I keep 25% of the portfolio in cash, and that's fairly consistent. That really has not changed over the years. And the reason I do that has nothing to do with return. I put a deliberate anchor on returns, but what it does is I'm always a net buyer of stocks. I never have to fuss over whether, whether I'm going to sell, what I'm going to sell. I never have to think about it. There's always cash available to be a net buyer. So I have deliberately eliminated my anxiety so I can focus on staying engaged with the market. So if you got to move on, but just in a way that I hope you can be engaged in the market for the long term. Anything you want to add there?
Well, Tim, I'll just say, when we started studying over at Stock Advisor our sales, how did we perform on sales? And it's not always clear, Tim, because you sell stock A, you might buy stock B. You sell stock A and stock B goes up 100 times.
Right.
All right, that's 10 times. That might have been a great decision, even if stock A goes up from the point that you sold it. So It's a little bit nuanced. But what I think, and Buck Hartzell and I and others had looked at this, and Tim, you might remember these days, we said our selling time, it'd probably be better if we would have held those businesses. I think what the lesson, my takeaway is, we probably ended up selling a little bit too late. Win, to Ed's point, win those businesses. Because if you look at the studies, and I've quoted this before, Tim, and you look at the studies, 40% of all businesses in the Russell 3000 over the time that they are in the index fall 70% or more from their all-time high and never recover.
Yeah.
Right? And that's just right. So
Law of large numbers.
Exactly. A line may never get back to its all-time highs.
Right.
Does that mean it can't be a great investment? Well, it used to be growing free cash flow 20% a year, and now it's growing 10% a year. So your valuation has to adjust. And I think for my sense, I'm trying to recognize when those businesses are shifting in such a way that the market is not yet caught up to that future state, because that future state is going to lead to a lower stock price. And it's very tricky, because you don't want to end up trading around positions, which is why, as Thomas said, David said, I've said, is that we tend to hold. Buffett was saying in his annual letter today, I'm not selling these businesses. Some of them are subpar, but I'm going to keep holding on to them. And it's going to be the biggest part of our portfolios. He was talking the ones they owned outright, the business that are going to drive the bulk of the value. Those are the very best performers. And that's what we've seen time and time again from our portfolios. But it does mean you have some of those ones that underperform, and having the allocation discipline is really important there.
Yeah. So I just want to validate, Ed. It's a great take. It's valid. I would just say, I think fools that are organizing their portfolios that allow them to stay in the game as long as humanly possible, that's the goal. That's generally, that's what we think the goal is. And so if you want to do what David Gardner liked to call pulling the weeds faster than, say, like I would, I have no problem with it. With it. For me, I tend to not sell out full positions because, and to be honest, Ed, just so you're clear that I'm not pulling this out of like scientific research. I'm telling you what works for me as an investor. I have been more deeply burned by selling early, and I mean I have been torched selling early, way worse than I have been by selling too late. So that's why I tend to index that way, but I have no problem. If you want to pull weeds faster, I have no problem with it. What do you think about Vion's question here,
Tim, I was
Andy?
it kind of parallels on what you were just saying about like not selling so early. So Vion's question on how do you approach position sizing, small cap companies like Serve Robotics, ACHR, Joby, CLBT, which is Celebrate, more speculative, volatile investments, better suited for a Roth or a taxable account. I'm not going to talk right now about the Roth or the taxable account, Tim, but just the position sizing. So I own lots of different stocks, and some of them are smaller positions that I've only bought once, and some are ones that I've built out positions up over time. Toby and I were saying this, when more and more I've been starting these smaller positions that I'm interested in, businesses that I think are just kind of interesting. I want to get to know them a little bit more. And I find when I own them, I just kind of follow them a little bit more rather than just having them kind of on a watch list that I might forget about. So that's a personal bias that unless you're trimming those, like we were talking about with Ed's question, you end up with a lot of positions, and that's where the allocation, but these are all very smaller, sub 1%. I think I was saying when I went back and looked at my last few buys, Tim, I think I was starting with kind of half positions, somewhere between 0.25 and 0.5% positions. This is me personally. And then I would build up to somewhere between a 1 to 2% positions on the ones that I want to have as like holdings in my portfolio, and the others I just kind of like let sit there.
Yeah. I mean, for me, I'll tackle the other side of the question. Is it better suited for Roth versus taxable? It's a better question for Bro than it is for me, but I'm not sure that there's a huge difference because you are talking about after-tax dollars. The advantage of it being in a Roth is, let's say it went absolutely bonkers. Let's say you had one of these investments and it turned into an just a crazy valuation such that you would want to sell some of it. and reinvest in some other stocks. If it was in Roth, then that sale would be, I believe, on a, you wouldn't be there would be no capital gains taxes on that. There would be that would be untaxed.
Yeah.
Whereas if it was in a taxable account, you would have to pay some capital gains taxes on that, or income taxes if it went bonkers in the space of a year. So that would be the advantage. But by and large, since you're using post-tax dollars for both, you're really only talking about outliers. I think overall, I tend to agree, Andy, that for those types of situations, very, very small positions have been my, that's the way that I've been approaching these, even just a share at a time. So yeah, I completely agree with that. So hopefully that answers Vion's question. I do want to quickly address Jenny Landaverdi's question from 3 hours ago, wondering about Samsara. So Samsara, I have a position that I plan on adding to in a pullback, but it just keeps going higher. What do you think about the valuation? I think it's rich. I do think it's a rich valuation. What you are betting on, Jenny, is that you will continue to see unit economic scale in the underlying business. And I can tell you there is some evidence that the unit economic scale, which would theoretically lead to a much higher, like what you have to get to is it has to scale to a very healthy free cash flow margin out, in the terminal period as you run a valuation on this. But I will say, so the fiscal year ended in February 1st of 2020, your cash from operations, negative 193 million. For the trailing 12 months, 35.9 million positive. And it has been moving this way steadily. They still pay a fair amount of stock-based compensation, so don't get too suckered by all that. They do have to deliver because they issue a fair amount of equity, but they are scaling. And so if you are going to buy, you are buying on the belief that there's going to be a dramatic expansion in that free cash flow margin, but it's not cheap. I'm not going to argue that it's cheap. You're talking about 25 times revenue. So there's a bit of a leap of faith here, but you do have to, the value points here are, I don't think it's crazy to think that there may be something here. The number of devices, you could think of one way to maybe not value Samsara, Andy, but like consider how it can compound over time is if more devices under management. Let's just explain what Samsara is.
Yeah.
So Samsara is a platform for using the cloud to manage Internet of Things, industrial Internet of Things devices. So like sensors on trucks, sensors in industrial factories and industrial settings. And the more sensors that you could think of it this way, like if you imagine that Samsara was a fund manager, Andy, like if it, let's say it was an institutional fund manager, like a big firm, a big asset manager. It's better for that firm if there are more assets under management. Samsara is the same thing. If there are more devices under management on the Samsara platform, the opportunity to scale up and earn return on all of those devices goes up dramatically. And in fact, it is asymmetrical. So you would hope that as that, the number of devices under management goes up, that your free cash flow margins would expand. And that's how you get return on this. But otherwise, it ain't cheap. Let's not pretend that it's cheap. It's not, but it is a pretty well-positioned business. Hopefully that helps, Jenny. What else you got? What do you want to tackle next?
Tim, no fool, KNOW had asked about DoorDash in the restaurant market. We touched a little bit on this, but I just thought we just kind of like put a dot on this. I think DoorDash's position, and I know Tom has been recommending it and talked about it recently also, and Tim, you mentioned it, is in a pretty sweet spot. They really specialize on the restaurant side. So that's like, food delivery, but they're doing other things, right? They have different partnerships that with delivery, but those deliveries where someone hands someone you want something, you shop for it, someone hands it to you, go out and deliver like a restaurant as opposed to going in Instacart and picking and choosing the different options. So cousins, I always consider them kind of cousins, and maybe they overlap at various points, but they're kind of cousins. But DoorDash, I think, is still in a very good spot. DASH, and I think it'll be a winner in that space, even though it's quite large and done very well over the last 18 months.
I mean, they're highly advantaged, and would you say that one of the mechanisms, an advantage of DoorDash is that they are collecting cash, up front? Like you have an order, they collect the cash, they deliver, and so they get, that really generous cash. Yeah, they get that generous cash conversion cycle.
Yeah.
And that helps them out a bit because they've been a cash generator for quite some time. This is not new for them.
Yeah. So just very quickly on that cash conversion cycle that Tim talked about, and Tom has referenced as well, is right. So businesses that are paid, you pay before you basically deliver the goods.
Right.
Has advantages, right? That has nice advantages. You get that, companies get that cash. They can wisely use it, invest it. And businesses that can do that and do that effectively as well as grow have some real cash dynamic advantages, and at scale that really does matter.
Yeah, for sure. I think Vian is asking me about Datadog, and so I was just doing a little back of the napkin math in my head here. I think they trade for about, if I remember here, Vian, it's about a 2%. Is it 2%?
Free cash for you?
I think so. Just do the math here. Nope, I have that wrong. It's about 0.5%. So it's still very expensive, I would say, Vian. Having said that, I do think they're better positioned than they get credit for. Would I be comfortable adding to my existing position? I'm in no hurry to add to my existing position at the moment, but I do think it's a fairly well-positioned business, and I don't think they get part of the reason they get not knocked too hard, but because why there's legitimate skepticism is because you can run up some very big bills running the Datadog observability platform. You can buy a lot of modules, and your bill can just like jack up really quick, really fast. And in order to manage cost on the Datadog platform, you end up shutting off features, which is not the most optimum thing. It would be better if you could like decrease your usage, but still keep most features. That would probably be a little bit better, but they don't do that. Like if you want to moderate your costs, you're going to shut some things off. But I mean, they observe a lot of things, and they help with a lot of things in terms of monitoring and optimizing infrastructure. And so it does turn out that most companies tend to moderate their spend, but they don't shut it off. And so it's one that I personally feel comfortable holding. I'm going to be careful about adding to it, to be honest, Vian.
Tim, there are a few questions just from yesterday I want to quickly hit, and then we can move on. So Happy Fool says VOO, the Vanguard EFT, is the most popular S&P ETF. See any issues with it being so popular? I'm curious. Happy Fool, no, I don't. It matches the indice. It has scale that allows cheaper costs. It's practically free. And when you're investing in ETFs that basically match an index, costs matter, and the cheapest one typically ends up winning. So no, I don't think there's any issues with the S&P ETF being so large. Mark H. Tim, and I want your take on this. I had a bad year in 2022. Looking back, I should have been backing up the truck and buying more. How can I train myself to do this during the next
one, isn't it?
Correct. It is very hard. I think for me, it's just the discipline to write things down.
Yeah.
Writing down is when I look back, I was going through my journal on some of the things during the Silicon Valley Bank and the period and the sell-off tied around that, and just how I was starting to feel, or was I excited or was I not? And it's easy in hindsight to say, gosh, yes, I would have backed up the truck. It's very hard to do in reality. So I think the discipline to take notes and write down what you're seeing in the markets and how you're feeling. And right now is the time to do it.
Yeah, I think that's right. I would also say that don't don't try not to beat yourself up too much here, because you can end up beating yourself up so much that
Oh yeah,
you just end up, paralyzed, and then you don't feel like you've
yeah,
got anything. Asit and I will talk about this tomorrow about
great.
operating versus, from a perspective, like when you operate from the perspective of not to lose
Mhm.
versus what can you win, those two mindsets are so different in everything. Like
Mhm.
it's a huge difference in like sports, but it makes a huge difference in investing as well. So I would agree with that. Write things down, and then I think it's just as important to, like, you have a natural inclination, as part of the purpose of improving, to dissect your losers.
Mhm.
Don't forget to dissect your winners.
Yep.
Don't forget to do that, because that will remind you that, yeah, you know what? Tom and David said anybody could do this. They're right. I believe them. I can do this. Like, you need that reinforcement.
Yep.
So,
And remember the historical patterns, remember how markets pull back, and remember stocks generally as a bucket move up and to the right over time. And so having that discipline to be able to remember that I think is very valuable.
yeah, I'm going to quickly address this one on Ed's question. The DEI initiative programs at companies, do you think they impact decisions of what to buy and sell by funds and individual investors? I mean, they might, but I don't know. I'm not sure why they would. I think, there's always going to be all kinds of different debates over what it is, what it isn't, whether it's a waste of money, whether it is. I really, for me, and this is kind of the way our company appreciates it. So this is how I look at it, Ed, and you can decide whether you think this is reasonable or not. Our company likes to go looking in areas where we think the market isn't looking for talent. And so we'll go anywhere to get the best talent. And that includes, like, looking for talent, in places where the people who you're going to find there don't look like either one of us,
Mm-hmm.
or don't have the same background as either one of us. We think that's just generally good for business. So that's kind of the way I think about it. And if so, I guess it depends on the investor, but for me personally, I love it when a firm will go out and say, like, yeah, we're going everywhere to find talent,
Mm-hmm.
especially like engineering talent, which is so difficult to find and hire. So, yeah, I don't know. I mean, I guess, but it feels like a big shrug emoji to me. As long as the company is going out and trying to expand its worldview to go anywhere for talent, I tend to be interested.
Foolis, just very quickly, Tim, and this could be a little bit of a controversial opinion. Foolis says, would you hesitate to buy the trade desk now for any reason? I kind of would. I'm not adding my position.
That's interesting.
Here's the thing is, I think when you see dramatic moves like this, it was the first time they haven't really lived up to their expectations. There's clearly some dynamics going through in their personnel, Jeff Green with his team, all those things. As much as I like trade desk in the marketplace, Tim, in the marketplace, when I see moves like this, I just think it takes some time for investors to kind of get used to this. We're seeing revisions coming down in the earnings estimates and all those kinds of things. So I'm not rushing to buy trade desk out. This year is going to be kind of, not in the stock, just on the growth side, probably not that exciting. And it's going to probably pick up again into 2026. But as of right now, like this time period, I'm not rushing out to buy the trade desk, but that doesn't mean that's not going to change in a few weeks. I let the market kind of digest stuff for a certain period of time when I see big moves, whether up or down like this in the market.
I mean, I don't have an issue with that. Although I have to say, seeing the trade desk get whacked made me think, like, maybe maybe it's something I want to take a look at. But I look, I don't think anything you said there it strikes me as perfectly prudent. So I'm good with that. I think that's fair.
And by the way, I wrestle with this myself too.
Yeah, of
I'm always like,
course.
oh my gosh, Trade Desk is down. Like that's one of my favorite companies. I should be buying it.
Yeah,
So
of
so
course.
I wrestled with this and it's also a decent sized position too. So even after that drop. So
Yeah, of course. All right. I think we are at the top of the hour here. So it should be that Alicia's going to come in any minute here and we are going to talk the rule breaker mindset. But yeah, thanks for your questions, fools. We appreciate it. Keep them coming. At the top of the hour though, we're going to do I did my screen shares this past hour. I promise no screen shares unless I get
I
forced.
wouldn't promise. Don't promise that, Tim. You
I
just
mean,
never know.
unless I get
You never
forced
know.
into it.
Yeah.
Like there may be a question
Yeah.
that'd be like, then I just can't help myself, and
Yeah.
that is yeah.
Well, before Alicia pops in, I'll just say thank you to all of our YouTube streamers out there who joined us to watch this. Thank you very much. It was great to see you. We'll be back tomorrow again from the 12 to 4 hour in the East Coast on YouTube. But if you're a member and still sticking around and watching Tim and Alicia talk all things investing, well, maybe not all things investing, but a lot of things investing.
The rule breakers mindset.
The rule breakers mindset. It's a great mindset to learn.